in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietyng.org for more details. CFA Society Nigeria, making finance a force for good.
Hello, good morning all, and welcome to the training sessions for the Research Challenge. Can you all hear me?
Yes, we can.
Okay. Thank you so much for participating in this year's Research Challenge. We welcome you from the Society office. We have our facilitators for this session. They will be taking you on the training in general, and I believe it's going to be an impactful and insightful session to all those that are participating. Quick one, please. Kindly ensure as participants that your audios are muted, and also do not share your videos. We do not want any videos to avoid bandwidth issues so that others can also enjoy the session as much as possible. If you have any questions, please kindly drop it in the chat box. The facilitators will pick it up and answer your questions as soon as possible. And you can also use the Q&A chat box also on the Zoom session. I wish you a very insightful session, an educative one, and how should I put it, a participatory one. You have a nice day.
Thank you very much, Bukola, and thanks a lot to the Society office for putting this together again. Good morning, everyone. Just to check, Oyola, can you confirm that my voice is audible enough?
Yes, it is. We can hear you.
Okay, great. I think to nudge the students, please kindly note, I know you must have received a few notifications around recording and the section be live streamed. So it's helpful that please just to note that this section is being recorded and also the session is being live streamed, right? Again, for privacy sake, you should be aware of that information, and also just to guide your actions and activity. Thank you. Again, the goal of this session, and as you will get to know over the next couple of, say, 2-3 weeks, is to bring you on board, provide you with, I would call it basic knowledge and understanding of the principles of the fundamentals that you need to know that will equip you to and also enable you to participate in this challenge in a very efficient and I would say more effective manner. Over the next couple of weeks, you will be going through, I'm not sure if the curriculum has been shared with you, but please, in case the curriculum has not been shared with you, let me know in the chat box if you have access to the curriculum. But essentially, the goal is to enable you to have access to this preliminary level of information. After each session, the facilitator would also be sharing with you basic materials, right? Let me use a university language now. Materials or books or recommended videos that would enable you to further the course or learn more about whatever it is that the facilitator also be taking you. I think it's also good for you to know that in the event that you have any question during the sessions, as Madam Bukola had rightly mentioned earlier, it will be helpful if you just drop the message in the chat box. the facilitator attention will be called to it, and your questions will be addressed accordingly. Now, should it be the case that you're unable to ask a question, or you would prefer to ask a question maybe after you've digested or redigested some of the information that will be shared with you, again, you can always relay that question in the interim with the society office, but over time, we will try to find a way to make it a bit more efficient for you to be able to relate directly, if possible, with the organizers of the sessions. As a form of introduction, my name is Samson Buhari. I'm a member of the Finance Professional Network, and just to re-emphasize, please, we would prefer that you put off your videos. I can see that Favor's video is currently on. Thank you, Favor. We prefer that you put on a video, and the idea is we want to ensure that everyone is able to access this session without issues with their network, right? So the more videos there is on, the more data demand that comes with it, and bandwidth issues can just affect some other people who does not have very strong network. So yeah, as I was saying, I'm a member of the Finance Professional Network, and the Finance Professional Network is really a network of finance professionals, named a lot, who have this very strong desire to give back in most way that we see them fit, and that includes supporting students, facilitating sessions like this, providing mentorship to the students. Again, the goal and objective of this section for us is to provide you guys with that basic knowledge I mentioned earlier. And over the course of this training session, we'll be covering every single thing that we think you need to know about the research challenge, and that would range from basic and fundamentals of financial modeling to evaluation, to how do you conduct industry analysis, how do you do a thorough business analysis, right? How do you even put together a report? What does it entail to put together an investment research report? And I can assure you that every single facilitator that will be taking you for these sessions are professionals within this space with a minimum of 4 to 5 years of experience doing the same thing you're trying to do. We have people who have been research analysts for over 4 years, and not just in Nigeria, outside Nigeria, who have done this for a reasonable amount of time. I'll stop there for now and introduce to you Abraham Drusa, who we refer to as our leader. He will be having a very short conversation with you over the next 20 minutes or so. And this would really just help you set the tone for this whole session that you will be into. Again, I really do wish you guys all the best throughout the session. I wish you guys all the best throughout the challenge, and please, again, if you have any question at all, do not hesitate to ask. And as you may be aware, the only stupid question is your asked question. Thank you. Abraham, please go ahead, sir. Thank you.
Good morning, everyone. Thanks for joining. If you can hear me clearly, please indicate in the chat box and just say good morning. I know you're all joining from different societies, so just drop good morning, Lola. I think you're the first, right? So just drop a good morning and indicate where you're joining from, what your society is. It would be nice to know, to see where across all the geographical spread we are joining from. So you can just say good morning, and also thank you, CFA, Zaria. Okay, fantastic. I'm very pleased to be here today, and I'm glad that after all the series of preparation for this, we're eventually here, and I'm glad that you were able to make it. I want to appeal to you, if there's anyone that needs to be here and is not here yet, please make sure they're joining this session so that they don't miss out on all the things that we're going to be doing throughout today. Okay, so I can assure you that it's going to be a life-changing experience. And I'm saying that having gone through this experience over the years, you will see most of the people that are coming to teach this class were at one time or the other in your position in the school societies, but today a lot of them are in different and diverse places all over the world and even Nigeria, across various sectors, from investment banking to asset management. We have two of our people in Harvard Business School, in Yale, in Columbia, all over the world, right? So I'm very glad that you made this session, and I think you should applaud yourself for doing so, right? Again, I'm saying all of that so that just to confirm the fact that I can bet you that it will change your life forever, right? And I'm saying this having seen people's lives changed over the years. Okay, so let's keep interacting. And I want this session to be very, very interactive, right? So just like Samson has said, ask questions, be open, right? And before I touch on a few of the things I want to say on my slide, I just want to lay this foundation, right? So that you come with an open mind, irrespective of what your background is, irrespective of what you know or don't know. Come with an open mind and be ready to absorb all the things that this platform provides all of us. I said all of us because, including myself, we're always learning. But having said that, I want to welcome you again. My name is Abraham Duro Shaw. I don't know if any of you have heard about me or know me before, yeah. And again, as this class is ongoing, please connect with us on LinkedIn, search for our names, look for your faculty members, reach out to them on LinkedIn, so that this is the beginning of a long and lifetime relationship for all of us, because we're all in the finance industry and we're all learning from ourselves. I represent the Finance Professionals Network. I was privileged to be the visionary, and even though it has evolved over the last 5 to 6 years, and we're doing this session in conjunction with the CFA Society, which I want you to always express your gratitude to CFA Society, considering the fact that they are at the background of driving the evolution of the Nigerian financial system capacity and competence. Critical to that is the CFA program. And let me say here that, I registered for the CFA program in the year 2010. Okay. And let me say that last week, or was it 2 weeks ago? Yes, I was privileged to meet and even to take pictures with the CFA Institute president, the CFA Society Nigeria president, the CFA Society UK president, and also our president emeritus, Banji, who taught me financial reporting in the year 2010, 2011. Okay, so I'm just laying that foundation to say that we are doing this because it has changed our lives, because we are evidence that if you apply yourself, you also can be like what we are today in the next future, right? So I'm very glad to welcome you to this journey. Currently, I'm a vice president at the Nigeria Sovereign Investment Authority, which is the manager of the Nigerian Sovereign Wealth Fund. I currently work there as the vice president, and I've, had many caps over the years, right? And, this knowledge is what we are using. And I like to lay certain foundations, right? For a couple of people who might be on this call, I might be wondering, oh, maybe I don't have a background in science, in finance, right? But before I go to that, yes, I can see somebody saying thank you, CFA Society. All of us, I want us to type it in the chat box. I want you to say thank you, CFA Society. I want to see all of you, just drop in the comments, say thank you, CFA Society. And after now, I want you to send an email as a society to the CFA Society saying thank you for putting this together, and thank you for investing in our future. Yes. So Like I earlier said, we are doing this in conjunction with the Finance Professionals Network. We are a society, we are a community of people who practice finance, from investment banking to asset management to research to private equity to venture capital to sales and trading to tech, right? And I think within the community, we should have over 2,000 professionals all spread across the world. So the community has grown to become very large over the years. And like I said earlier, we are all beneficiaries of the CFA program, the CFA Institute, and the CFA Society. Okay, what will you learn? To hint on that, as I begin to wrap up so that the next session can take over. You will learn all it takes to be a well-rounded finance professionals. Now, there are certain goals that we have in mind while this program has been put in place. One is we have looked at the CFA Research Challenge, and we felt that a program like this is important to help all the societies and all the participants to be well-skilled and well-equipped so that by the time you are putting in your presentation in terms of your research report, in terms of your slides, and in terms of, I know that they've shared with you the company that you're going to be researching and be preparing your report around. We want to be able to create a platform that in the near future, and it can be 2024, societies in Nigeria, clubs across the institutions in Nigeria can win the CFA Research Challenge on the global scale. So let me ask you, which society here wants to win the global CFA Research Challenge competition? Put this in the chat box. I want to know which society, which club will win. Put this in the chat box, let me see. So that is our intent. OAU, who else? Ilori, Ibadan. So that is our intent. Our intent is that you will win the global challenge. So I want you to set the bar high in your mind. And it doesn't matter what university you're joining from. And let me say, I also at the Federal University of Technology, Minna, and I studied physics. Which goes to my next point. It doesn't matter what you currently study in school. I'll be studying English, I know you're in all the different societies club. Yeah. So you might probably you study economics and business admin, accounting. Yeah. So some of you might have some advantage over some others in terms of what you study. I study physics. So if you think your situation is bad, just think about me that study physics and availed myself of maybe an opportunity like this. And let me tell you, we didn't have all this opportunity that you have today to interact with people who are practicing, to be part of a challenge like this where you have an opportunity to learn, and that changes your life. Okay, so if you think you're at a disadvantage, perish that thought from this minute. Okay, what will you learn? We have put together a robust curriculum. And again, thankful to the CFA Society, where we have looked at all the things you've covered. You need to cover in terms of this program. So part of what you should expect, I think this morning you're having a session on financial modeling. How many are you happy to learn about financial modeling? Put it in the chat box, right? So you learn about financial modeling, you learn about business analysis, you learn about PowerPoint presentations, you learn about corporate finance, you learn about equity research, you learn all these components that will put you in a position to put out and put forward a very strong case, a very strong research on behalf of your societies, on behalf of your clubs, on behalf of your institutions, so that you can win the global research challenge. Primarily. Then number two, I can bet you that your own life will not remain the same by the quality of things you're going to learn in this program. right? I believe that, the details, you received all the invites for all the classes, so you have an idea of all the different courses you are going to be doing, but I'm just laying this foundation so that you can open your mind. If there's any bias you have that you feel might be a reason why you may not make it, is not possible. You will do well. You will understand it. You will get it. You will become a professional in these areas. Okay, so those are the things you're going to learn in addition to practical experience that we're bringing to you. So like Samson has said earlier, the average person that is coming here has experience in the areas they are coming to teach on. Okay, so ask questions. I'm privileged to be talking to you and opening this program. This is my 16th year in finance. And we're going to be making ourselves available even after the class. So feel free, ask questions. Most of the people teaching these classes, they were winners of CA Research Challenge. So they are coming with a lot of experience and a lot of practical knowledge. So open your mind, ask questions, listen attentively, make sure you don't miss the sessions, go back and reread all the things you have learned, get writing materials, take down notes, reach out to us, be ready, open your mind, be ready to learn. After this class, go on YouTube to go and search and go and deepen your knowledge. And why is that important? Because this class is how many minutes? Maybe 1-2 hours here and there. It is not enough considering the scale of knowledge you need to do well, whether as a professional or whether even to win the CFA Research Global Challenge. Because what? The same way you are preparing. Some people are having sleepless nights in other parts of the world preparing for this same challenge. Okay, so you have to put in the work, right? So I just want to encourage you this morning to, number one, take seriously everything about this program. Every minute, take it seriously. You need to join class on time, be here spot on time. You have assignments, make sure you go and study the assignments. You have reference materials, make sure you go and read them. Okay, you have something you don't understand, don't wait. Reach out to the faculty, reach out to all of us who provide you answers. Send an email to the society. So that seriousness is critical because no matter how much, I know some of you have been to buffets before, no matter how much food is on the table, it is left to you to go and pick what you want. So we are bringing this program, we are bringing this faculty, we are bringing people who have upward of 5 to 10 to 20 years of experience. We'll have senior professionals in the industry who come and stay a word or two with you. No matter how much we serve the table, you determine how much you're willing to eat, right? So that seriousness is very critical. 2, I have talked about asking questions. Like Samson said, there's no foolish question, there's no wrong question, there's no right question. Open your mind, ask, and ask until you understand. And then thirdly, maximize this opportunity. It's a once in a lifetime opportunity. I believe none of you is paying to be part of this training. And I'm sure I can bet you there's no training like this in Nigeria, in Africa that I know. And I can tell you, people are begging us to be part of this program. And we said, no, this is strictly for the societies and the clubs who are contesting in the CFA Research Challenge. I have colleagues even in the office, I have senior professionals who want to refresh their knowledge or think there's certain foundation they missed that they wanted to be part of this program. And we said, no. So it is in the best of your interest to take advantage of everything that this platform is providing you. Okay? And windows of opportunity opens once. And if once it's closed, you will see that people will leave this program and tomorrow you hear the embark of America and they will look back and say this program changed their lives. Our expectation is that will be the story of each and every one of you on this call. Okay, so having said that, that is the end of my presentation. I hope I've done a good job of welcoming you onto this program and also encouraging you to take full advantage. And more importantly, point I would like to repeat is, it doesn't matter what your background is, it doesn't matter what you studied, it doesn't matter what you're currently studying, it doesn't matter what you think your disadvantage is. This is an opportunity to translate all of those disadvantages to an advantage. If I can have a background in physics with no knowledge of finance, economics, or whatever it is, and I'm here today, there is nothing that can stop you. On that note, thank you very much. I'll hand it over back to Samson, who will then introduce the next, the first teacher who will take the first class. Welcome again to all of you, and thank you for being part of this.
Thank you, bro. And I mean, just to couch this thing that, you know, Abraham has been like a father to many one of us. To many of us, he has been tremendously supportive to and helpful, you know, and his efforts as you know, has been what has enabled a lot of us to have that exposure opportunity that we have today. So it just rings back to, and I'm sure in the nearest future, you all would be in the position to start volunteering and supporting younger people. You should try to remember today that everyone giving their time, resources to put this together, you know, were ones like you, and like Abraham mentioned, some really did not have this opportunity you're having. And I would really advise and encourage you to take full advantage of this opportunity, so that you know, in the future you can always point back to this moment and be proud that you're part of it. Having said that, I would really like to make a quick introduction to the facilitator for today's program. His name is Damilola Karim. Damilola Karim was, I think, 2019. Sorry, he would correct me when he comes on ground, but he represented OAU in the Research Challenge in 2019, and you know, afterwards he has worked with Axel Mansard in equity research, portfolio management. I think Axel Mansard was portfolio management before. He even had a short stint. I think he was saying that earlier with the CFA Society office, where he really was putting some of his accounting knowledge. He's an accountant, by the way, the chartered accountant, putting his accounting knowledge to you know, support the society of in those early days. And currently he works with the Bank of America research team and strategy. I'm sure he can tell more, if he deems so, can tell more about himself. But without further ado, I would like to introduce Damilola Karim. He will be taking the section of financial modeling. I myself, Sam Boari, will be handling the conversation with you. So if you have any questions, apologies due to the time constraint, we will not be able to stop or intermediate, but we would be able to like have short breaks where you can take those questions. The plan is to have a straight 40 to 45 or 50 minutes, take a 10-minute break or 15-minute break, then come on back to continue. We'll do that in sequence, right? 40, 45, 10 minutes, 40, 45, 10 minutes, such that you can also have time to relax and refresh yourself in the course. So Damilola Karim, you're up for. Thank you.
Thank you very much, Samson. Good morning, everyone. It's really a pleasure to. I was listening to AB and I was just smiling here because about 4 to 5 years ago, I met AB when I was trying to figure out my way in finance. And I remember also about 4 years ago, I also participated in the CFA research program. And I would say that most of the things that I would call foundation today, I learned from them. I think today, not to like waste much of our time because it's going to be a long one, I'll be doing a mini presentation of what, you know, financial, if you think about it. Then we're also going to be having, you know, the, you know, on Excel modeling. I don't know if you all have the templates, which you might want to probably like, do it together with me, or you might just want to probably like take your time, just, put your eyes on the screen. Then I know this is a recorded session, probably like right after you can go back to the recording and, watch all the steps. So I think today, most of the videos you see out there is just, telling you how to model 10%, put this here, put that here. But I think the most important thing when it comes to modeling is one, understanding why exactly you are modeling. What exactly it is are you trying to achieve? Because not
Sorry, Damilola, I
uh,
am so sorry for cutting you. So sorry for
right.
cutting you. Can you please put on your videos? I mean, it would be great to have your video on. So, and then when you're,
Can you
and
see me
again,
now?
yes, please, and please, to all participants, would we kindly request that you please put up your video. And again, to re-emphasize, the idea is to ensure that everyone is able to participate in this session in a very efficient manner, and so that there won't be issues with their network or bandwidth issues if we all have our videos on. And I sincere apologies to anyone that we have had to turn off their videos, but we just want this to be as efficient as possible. So Damilola, again, apologies for cutting you. Please go ahead.
No worries. Right. Okay. So I think today's approach is going to be a little bit different. And I would say that most people, when it comes to modeling, you are doing the research challenge competition, and I'm sure that a lot of you are probably like, arguing it out that you really want to be the one that will build the model. But I think looking back, one of the common mistakes when it comes to modeling is that everyone wants to all get their hands dirty, but most people don't take it, the time. What exactly are we doing here? And how are we supposed to like, think about it from, a whole picture perspective? So in that case, we are going to be spending a lot of time, talking about how to think about the input that goes into the model. We are going to spend a little bit of time talking about assumption. How do you think about the financial statement? And how does all of this thing integrate, in becoming a research report? So I'm going to do a very short presentation. But before that, I need to put a disclaimer out there that our discussion today is purely academical, and the resources and exercises that we do today does not reflect any approach of my employer. So I don't know, just let me know if you can see my screen. Can anyone?
Yes, you can see your screen.
Okay, thank you very much. So basically, let's what exactly it is and what exactly it is not. Today is not necessarily going to be an accounting class, but it's going to look like it. So what that means is that you're going to be dealing with, financial statement, financial analysis. We're talking about ratios and, how all of this thing works. Today is also not going to be a class on economics, but it's also going to sound like it. Because for you to do a proper financial model, you need to have a little bit of understanding, not a little bit, I think. I would say you need to have an understanding of, of how the macro and micro works and how all of these things affect a company. Today is also not going to be an Excel class. Of course, we are going to be using the Excel environment, to prepare our financial model. But let's, start from the basic, because I understand that some of you might not have, a background in accounting or economics or finance. But to be very honest, it doesn't change anything. Like AB said, maybe with a lot of people that I know probably like study way different thing, and they prepare very good model today. So your background does not necessarily matter. All you just need to do is to like, have that open mindset and follow through basically. And I think the more you continue to like practice, then you get better at it. So compared to me about 4 years ago, when I spent about 4 months or so building a model, because I was always calling industry guys, how am I supposed to model this particular thing? How am I supposed to model this particular thing? I think the main reason why it took that long is because as a team back then, because we're quite, I would say novice, I would use that word, is because we didn't really know what exactly it is we are trying to achieve on a big picture. We think we're looking at it, separately. And I think for you to be able to like do a proper modeling, you need to have that big oversight of this is what we are trying to achieve. So that way it will make more sense. So, I mean, according to say, because I was looking at the curriculum and they define financial statement modeling, and they said it is not necessarily a quantitative or accounting exercise like we would of an analyst expectation of a company and its competitive environment. So basically what that means, the end goal of everything we are doing today is that we want to have an opinion on a company, right? We want to give a recommendation to investors. If you have $1 million today, the question is going to, would you buy this particular company that you are going to be carrying out your analysis on, sell it? And if you're an existing investor that already owns the stock, would you continue to hold on to it? And the bedrock of this analysis start from modeling. So you want to model out the company, you want to look at the numbers, not just it, right? It comes back to what exactly do you think about this company? And for you to think about a company, you need to think about its environment. And what that means basically is that you need to understand the macro condition. And that is why I know that a number of you probably, you would have checked out the financial statement of this particular company you want to work on. You would have probably like annual reports. You see things like a chairman statement talking about the environment, talking about easy or how it is uneasy in terms of like macroeconomic condition and how all of those things is playing out in the company. You hear things about how inflation, for example, is an issue, how supply chain is an issue, how COVID affecting demand and everything. So having that understanding, having that expectation flows down from the top. It comes back from what's happening in the global economy. Then how does all of this thing play out, in a country like Nigeria where your subject company, is located and operating? How does all of this industry where your company is operating, in what business cycle is your company in? What does the competitive landscape looks like? These are all of the things that we're going to be talking about, because having the understanding of all of those things will help you have an opinion of how you think the company is going to perform in 1 year from a capital market perspective. So is this company going to be profitable? Is this company going to generate a lot of cash flow? Because at the end of the day, right, we want to have a company that is profitable. We want to like invest in a company that is making profit. We want to invest in a company that has enough headroom, enough cash, to either organically, or they are also like probably buying, company, acquiring company and getting big. So there are some metrics, key metrics that as an investor in this case, there are some metrics you want to see before you can invest in a company. And it is your job as a risk, and all of you right here, I'm going to be addressing you as an analyst. It is your job to then say that, tell your investor who is probably like, an asset management company who is investing, you want to tell them that this particular stock, this particular subject company is a buy, or this particular subject company is a sell, or if they already have it, it's a hold. And someone who has $1 million is not just going to listen to, oh yeah, you can just buy it, you can just sell it, and they'll just call their trader and say, how about you take a position in this company? It's not going to work that way. So the investor is going to tell you why. Where exactly the thesis? Why do you think I should buy this company and not that company? Of course, all of this thing is not, because I know there are some other sections for that, but I'll be touching a little bit of it because all of this thing is what plays out into modeling. All of this thing is what, inform an opinion in how you build your model. Of course, there's a lazy approach, and I will tell you the lazy approach. And there's also like, the analyst approach, I would call it, because the lazy approach is to just, do certain things, just be mechanical in the whole thing. You want to build a model, then you build a model, and that's it. Then when they start asking you a question, you can't defend your number.
that is the lazy approach. Of model, you have a financial, it's going to look like a model, but it's not necessarily a model, because the whole point of a model for you to be able to express an opinion about a particular company from a financial perspective, right? So that's the CFA Institute. So we have different kind of model out there that you might be familiar with or you might not be familiar with, which is fine. One we are going to be working with today is the one I started, which is the three statement model. So basically, when you look at a financial statement, or when you hear the word financial statement, some certain the three common statements in a financial statement is one, the income statement, and the income statement is the one that helps to show or to reflect how a company has performed in a particular year, in a particular accounting year. It usually takes like 1 year, about 12 months, which is like the operating. And so that's the income statement, and the income statement helps to show what the company has done from a top line perspective and how they've performed, from a bottom line perspective. And when I mean what I mean by top line, bottom lines, if they are rendering services or they are selling or they are manufacturing, what does revenue looks like, and how what has the company done in terms of like cost, to acquire that. And what are the other things like, which all of the things we're going to be discussing today. The bottom line is, at the end of the day, the most important thing at the end of the day is that profit or loss. And that is what the income statement is there, to tell you. Then moving on from there is like the balance sheet. So the balance sheet is basically, a statement of financial, position. How, it shows you what the company owns and what the company owes, right? And at the end of the day, when what the company owns, which is more than all of its liability, then it's what is left is usually like what belongs to the equity holders. So that is like the statement of financial position, position, which is also called the balance sheet. We are going to work out. We're going to model that. We're going to model the income statement. We'll model the balance sheet. Then the last thing we will model is the cash flow statement. Well, I don't know, for some people, I mean, as a student of finance, you must have cash is king. At the end of the day, a company might make a lot of profits, but they're not converting that profit to cash. And what investor likes the most is, is cash. And that is where, when in your valuation class, which you'll be having at some point, they will tell you, like, fundamentally, right, the value of a stock today is the present value of all of its future cash flow. So the cash flow, because we are having certain assumption that a company is going to be existing into, right? So we're not expecting the company to liquidate anytime soon. So we believe that the company is going to continue to make profit. We're going to convert that profit into cash. And going forward, by the time what we want to do today is that we want to like buy the stock today. So what exactly does the stock worth today? So you look at all of its future cash flow, then you discount it back, to the present value to say, as at this future cash flow, worth this particular amount. And for you to be able to do that, one of the key statements that we look at is the cash flow statement. The cash flow statement says a lot of things beyond what I just. From an operational perspective, how has a company performed? From an investing perspective, how the company performed, and from a financing perspective, how has the company performed? The whole point is that you are looking at when the company makes profits, all of this thing is, the profits they were able to make from the operational side of things. So when the company makes enough money from the operational side of things, then they will be able to have enough to invest. They'll be able to have enough to find, to probably like pay off their loans that, they initially, and all of that. So we are definitely going to be talking about that. So basically, that is what we are going to be doing today, the three statement model, building it. How do we build it? How do they interact? And how do you think about the line items? Of course, we also have the DCF, which is something I kind of like just explain in a way, because the DCF is extension of the three statement model, which kind of like sit on the three statement model. It is, we have the valuation side of things. They will tell you we have the cash flow of the companies, and this is where we prepare a DCF.
We also have merger model, which is like mostly used by investment bankers, just to like, to see whether two companies will be having an accretion, whether, when you put them together, whether the company is going to achieve some, synergetic benefit, for example, or, both of them coming together does not make sense. So they built this kind of model. IPO, when a company, for example, is a private company, but the company wants to now get listed. So when the company wants to get listed, we want to like ask ourselves, because it was initially private, so that means it's not accessible to investors. But now that it's going to be accessible to investors, how much does it worth? So we prepare an IPO model in that case, leverage buyouts, when the company wants to acquire another company, and they're going to be using a lot of debt to be acquiring it. All of these things you can read up, so we won't take too much of time on it. But the key thing that we're going to be discussing today is the three statement model, and how it interacts, because I think that is the foundational model. Once you have that idea of how the three statement model works, every other thing builds on it. And as far as your CFA research competition is concerned, right, you need to build the three statement model. You don't really need to build an M&A model, except you think your subject company is going to be acquiring. To be honest, you don't even need it. And of course, your company is a listed company, probably like exposed to a leverage buyout. So you only need to build this three statement model. So that I think let me just take this to the slideshow. Let me see. Okay. Right. So I think I've mentioned something, but I'm going to be repeating it anyway. So there's the analyst methodology. I think I told you approach, and we have the analyst methodology. We are going to see all of that when we start, building a model. But when you think about modeling, right, what does it take an input from, and what is the end goal? The input is like, when you want to build a model into the future, you want to understand where the company is coming from. And for you to understand where the company is coming from, you'll be able to achieve this through financial analysis. I know there's a separate class for this also, but it goes both way. You get to like do a few historical analysis. How has the company performed previously, and you'll be able to achieve this through a financial analysis, doing a ratio analysis, doing common sizing. These are different approaches that you can use in like preparing your historical, and it gives you an idea of how the company has performed in the past, and that how a company has performed in the past does not necessarily equate to how it should perform in the future, but the past give you a base of where to start from. And that is why we tend to do a financial analysis, company has performed, and most of the time we do this through ratio analysis, what does the company looks like in terms of like their gross profit margin on the profitability perspective, their EBITDA margin, their EBIT margin, net profit margin, return on equity, these are things that we're looking at from how the company also performed, from an efficiency perspective. So, in terms of like working capital, how has the company been able to like, utilize its receivables, and all of that. But I'm not trying to, I don't want to like bulk us up a lot of things now, because I think that these are the things that will make more sense to you when we start like, the modeling. So we do a lot of financial analysis, analyze the financials, the existing financials. Then we use that as a base for us to forecast. Then when we forecast, of course, the end goal is for us to like then use number to value the company. And the key drivers, or of your model, and probably like the likely impact of trend when you're looking backward. Before you start modeling at, the lazy approach, or sometimes when there's time constraint, or they've given something to a junior analyst to quickly, maybe the company, they want to initiate, if you want to initiate coverage on a particular company, or if you want to, you've not built a model on this particular subject company before, but now we want to build it so that we can pitch it, right? If you give it to probably like, a junior or an intern to say, oh, for the laser approach for that junior or for that analyst, for the analyst or the junior person in this case, to just, do a mechanical approach. And what that means is that the person is going to pick up the financial statements and go into Excel and first start with imputing the historicals. And when I say historical, we are currently in 2023. For a subject company, your historical could go as far back as 5 years. The more you go back, the more you understand the history of the company. But it is generally acceptable for you to just go back 5 years. For some company, some company may not even have up to 5 years, or they may not be, they may not have been listed for the past 5 years, or they may not have enough financial for the past 5 years. So as far back as it's still sufficient. We're still going to talk about, how some, historical let's say, for example, COVID year 2020, how that can probably like mislead the future performance, or the way you are going to be thinking about your modeling going forward. But the laser approach here, or the mechanical approach, is for you to prepare, pick the financial statements, then you replicate everything in probably like the financial statement of that company and replicate it in your Excel. Sometimes as it is. And when I mean just as it is, the way it was presented by the company, you are putting it right in the sheet. But in some analysis approach would be that and this comes with experience, and this comes with you understanding the company, you might look at the financial statement and you feel like the presentation from a modeling perspective is not great, and you want to prepare your own arrange your line item, or you want to arrange your financial statement in a way where it will be easy for you to model. Sometimes that is going to be, we are going to probably like get to that point when we get to like the modeling aspect. But you replicate, basically you start from replicating what you have in the financial statement and replicate it in the Excel. And of course, you will start linking up the Excel. So what that means is like, you're going to like probably like do an average of like the past, an assumption that that's what is going to continue going forward, especially when the company is in a stable company. And all of this thing also comes back to, where the company is in its business cycle. And when I mean in its business cycle, a company might be new, might be in the growth phase, or might already be a matured company, and nothing much is really changing year on year. So in that case, like averaging it to make a lot of sense, even for for a junior. But for a company that is still that is or that is in an environment where a lot of activity is going on, and there is a potential for growth, a lot of things can be changing year on year. So averaging it out, for example, might not make sense. But as a start, you pick up the financial statement, put it right there in the Excel, and you just link it up. Basically, that is your job. Approach, or someone with experience to come to that model to say, oh yeah, going forward, we don't think this is going to, it's going to like, change and everything. And as an analyst in this subject company, you who are participating in the research challenge, so your subject company, for example, before you start modeling, I don't know whoever it is, probably it is one person in the team that's modeling, probably like it is everyone bringing a head together. And to be honest, I think the better approach is for you to, everyone bringing their, their view together, and they're putting that into number. Say for example, you have someone who is like, who is a very strong person in the macro space, in the macro bit, that understand the economics and everything. You need that person to do an industrial analysis, for example, to understand, what is, convert that into an opinion of what you think the company, you have someone who probably like has taken their time to understand, your company. They've read through their annual statement, they've read through their earnings statement, they've read through their press release, they've listened to the management guidance on the call and whatnot, and they have an opinion about how they think the company is going to perform, to look like going forward. And so all of this thing plays out a bit to come into the numbers. So that is why I said when you think about the key driver, the first thing to look at is you need to understand your subject company. You don't just pick up the financial statement and say, oh, last year they did 10,000. The next year they did 12,000. Then that means that the year that follows they are going to do like the growth rate of looking at the 12,000 and the 10,000. How much has it grown? Then you grow the next one just like that. It doesn't work that way sometimes, and sometimes it does. So I think you need to understand the business. So what's the company's model? What exactly is the company doing? I know that your subject company is not. So what exactly is the business? And when you talk about the company model, you are thinking about a lot of things. So what is the company producing? Who are its key customer? How does it get its input, right? Does it import a lot of input? Because if the company is importing, for example, it's going to play out into FX. FX, for example, is something you have to think. Inflation, global inflation also is something you have to think about. Then think about it before you think about the inflation in your country, and all of that. So these are the things that you need to understand the company model. What are its key products? How does the company price its products? Is it a company that is because when you think about pricing, is if a company is, let's say, the market leader, the company will be able to price in a way where they'll be able to pass through, let's say, things like the majority of the input costs to the customer. So if inflation, for example, is rising, when you understand the company to a very good extent, and you feel like you believe that the company is strong and is a market leader, you believe that the company will be able to, like, probably pass through, like, some of, like, inflation, for example, and pass it through to their customer. But if we're in a very, very competitive environment where there's a lot of product, there's a lot of substitutes, and these are the things that in your industry analysis, things like the Porter 5 forces model will help you to figure out, like, is the company, in an environment where there are a lot of players? If that's the case, are those players also, like, strong? Do they have, did they come market share? How strong are they in terms of, like, pricing? And I think one of the interesting one going on in Nigeria is the Dangote cement and BUA. People trying to, like, take advantage of, like, discount and quality of, compared to the quality of that product. So they'll be able to, like, when you price it down, for example, and the quality is very good, the company has a will definitely, like, take advantage of that and buy more of that particular company's products, which of course drives up their revenue. And another key thing is management guidance, and this is very key. But I know I don't know if you are going to be having a session with the management team of your subject company, but if you are going to be having that session, I want you to take advantage of that to ask all the questions that you can, all the equity story. You want to ask question around the equity story of the company. You want to ask the CEO, what do they think about demand in this competitive environment, or in this current, environment, where people, consumer power is, like, declining. People don't have a lot of money to buy essentials and whatnot. You want to ask the company certain question about their strategy. What do they think will happen to profit next year? How is the company thinking about growth? Is the company going keep increasing in capacity? And question like that, if they're giving insight of, oh, we keep building, that's giving you an insight of, like, oh, there's going to, you need to factor in a huge capex, for example, into your model. If the company is telling you we're in a very, very tough environment, we think consumer demand is going to be, it's not going to be strong, you want to start thinking about your revenue growth. If the company is telling you that they import a lot of their inputs, for example, what they use in making their product, they import it from a certain country, like, let's say, Ukraine. You want to think about, oh, supply chain issue, how that impacts your cost of example. So management guidance and having all of this understanding of how the company works will give you an opinion of how you think the line items, how you think about your revenue. When you also think about it, the industrial analysis, I think I mentioned this. You look at the macro competitive landscape. How is the company a market leader? So if the company is a market leader, the company is strategically positioned in a way where they will be able to they'll be able to direct how their product is going to be demanded by the final customer in this case, how they able to beat competition and whatnot, supply and customers. So having an idea of all of these things have a way in playing out into your revenue, your cost forecasting and whatnot. Then the last bit is risk analysis, which is scenarios. When you talk about scenario analysis, basically in simple English, it is you acknowledging the fact that the future is not constant, right? In 2019, a company that is probably seeing a lot of activity, a company that is probably not an essential, where people only buy it when they have money, will not expect COVID to happen. And when COVID happened, then there's a lot of issues. People were focusing more on essential. People were not, buying certain products, and a lot of things were changing. So scenario analysis helps you as an analyst to factor in possible issues that could happen, possible scenarios that are unforeseen, because you are talking about the future. So you are only as good as what you know now, right? Your input is only as good as what you know now about the future. And most of the companies also in their annual statement and their annual report, they do this session on risk where they highlight, oh, these are the key risks of our business. FX could be an issue. It could be a supply chain issue. It could be follow-up of COVID impacts, like COVID impact is still going on and all of that, in some businesses, and they'll tell you these are the things that could play out that could affect the business. And when you have that kind of situation, how do you factor in a scenario analysis into your model in a way where you are saying, on a normal business activity, this is what you expect, this is how you expect the company to perform. If for example, in Nigeria, if the president plan, for example, if the strategy works and you think that, if they've given out some guidance of where they expect GDP to be in certain year and whatnot. If you think that's achievable, you could do a best case scenario that if this work, then what will happen to the business in terms of revenue, their cost and everything. How does that impact the business? Then of course, in a worst case scenario, let's assume that the worst happened. What will happen to the company? How will the company be able to navigate this particular thing? And all of this thing is something that you also need to factor into your model. And doing that would make you have a comprehensive model where you are not just talking about the future, but you've also been able to give scenarios that could play out and what that will mean for the numbers. So I think the final thing here that I just want to point out is garbage in, garbage out, which I call GIGO. And most people, there's the bit of when you're modeling, when you continue to look at a number for a long period of time, it start looking like it's making sense. But sometimes your model could be jargon, right? And it will be jargon if you have the wrong input. Let's say, for example, next year, you think that the company is going to, make 10% of they are going to achieve 10% volume growth of their product. They're going to sell 10% more than they sold this year. And based on your own opinion, based on probably what you've done, your analysis and everything. And at the end of the day, the company was only able to grow 2% or 1%. That growth rate difference could actually makes a lot of difference when it comes to the value of your stock. And that is why most times from a research analyst perspective, of course, companies also like report on a quarterly basis. You tend to like revise your opinion on a quarterly basis, and that is why sometimes you have consensus. The companies, we are expecting the companies in the next quarter to deliver 5%. Then in next quarter, the company delivers 8%. Then what happens is that's a potential, that's a positive catalyst, and before you know it, the stock price is going up because what the analyst has expected, the company has achieved more than that. And because since they've achieved more than that, it would have affected how the numbers will look like. That means the numbers are actually better than what you are forecasting, and it plays out into the valuation of that stock. And the reverse is also the case when you think the company is going to do 10%, 15%, and the company comes back to do like just 1%, or the company will even saw a decline in their revenue. Then before you know it, like the stock will tank and all that. So the difference between being smart and having the right number, you might be the smartest guy in the room. You might, have all of this modeling Excel ninja skill, but the most important thing is not just having the accounting knowledge, the economics knowledge. You know what's going on in the macro. All of this is going to play out into the company and whatnot. But the most important thing, and that is why sometimes someone who does not really have an experience in accounting, or who doesn't have whatever background, they tend to come in with better approach when it comes to modeling, because they tend to focus more on what is right rather than trying to prove a particular point that this is what their opinion is. So take time to look at your number and justify why you think this particular thing is going to be this, or why you think this particular capex for the company, whether you think this company is going to be achieve this particular capex, or whether this is going to be this and that. You need to like have a justification. Once you can justify a particular thing, and sometimes not, you don't have to, you might not necessarily have the opportunity to justify all your numbers, because the management is not guiding on it, or maybe because there are few information that could guide you to like make the right decision, or sometimes it could be a case where you just want to like you just feel like in your own opinion management is saying something, and you feel that is too ambitious, and you are a little bit conservative sometimes, and that is what will make a difference in among the school, because at the end of the day, everyone is going to prepare the model, everyone is going to prepare evaluation, everyone is going to write a report, right? But what is going to differentiate A from B is when a particular school comes out to say, "Oh, we think this particular subject company is a buy," and the next school comes to say, "We think this particular company is a sell." And when you hear the thesis, when you hear the arguments, they will both make sense. But you're right at the end of the day, and somebody will be wrong. Sometimes it could be a case where someone is right, that thesis is right, but performance, for example, or the macro situation kind of like changed, and it's kind of like just messed up with their opinion. So sometimes you can still be you can be right in terms of like your input, but you may end up being wrong, in terms of like your ideas and whatnot, because there's a lot of things playing out and a lot of things can change. But the more important thing is for you to have the right numbers. So, I mean, before we go into like proper modeling, for people who are not familiar with accounting and whatnot, this is pretty much what a pro forma income statement looks like. So when you're preparing your financial statement, of course, you want to start from the sales, from the revenue, which like kind of like help to reflect, what the company is, providing in terms of services, whether they are selling products, whether they are selling services and whatnot. In your subject company case, I know they are selling products. So and when you think about sales, the way to think about it, so when you want to start building your model, there are different ways to think about your revenue, and you don't want to get it wrong, right? So revenue, you could model in different ways. You could model it from, you could do a geographical segment, or you can do a segment analysis, for example, looking at the product segments, or looking at the geographical segment. In geographical segment case, we tend to do that more often when we have a company that is selling to different countries, right? So if, for example, your subject company is selling 50% of their products in Nigeria, and they're selling, let's say, the remaining 50%, in the neighboring countries, you may want to do a segment analysis of your revenue. You want to forecast your revenue by geography, because the macroeconomic condition, in Nigeria may be good, and in some other neighboring countries, some things could affect your revenue in this case, or the way, the amount of your product that you sell in that case. So you want to probably look at how is this company going to perform in Nigeria, is country going to perform in different region, then you bring them together. So basically that is one way. Another way is that if the company has a lot of products that they are selling, right? So some products may have different drivers. It could be that certain things, what is driving this particular product may not necessarily be what is driving this particular product. Let's say, for example, a decorative paint, or let's say something you use in the paint you use in painting, let's say home, for example, might have a seasonal driver. Or let's say in December, everybody wants to paint their house, everybody wants to kind of just rearrange their home. So maybe there's a seasonal effect of in December, or in the last quarter of your accounting year, you tend to have more sales in decorative paint, for example. And let's say we have another kind of paint that is used in factory, and that may not necessarily have a seasonal effect, or that may not even be something that that will have a that will see a negative impact when you have an economic downturn. Maybe companies are still producing, activity is still going on in the manufacturing space, and they continue to need particular type of paint. So what I'm saying is that you don't sometimes you don't want to look at your sales from you don't want to look at your sales as a whole number and just just drag it out. So you want to look at what makes up this particular sales. What is the company's selling? So if it is a segment of products, you want to look at it by product if you can, and sometimes if you cannot, that is easily look at how everything has looked like year on year, then you'll be able to have an idea of what it looks like in the future. But of course, when the company, for example, is preparing a financial statement, or they are doing a press release, and they are breaking down their sales, for example, by product, they're telling you how this company particular segment, in this particular segment, then at that point, you may want to look at those segments and watch out for what is driving each of those segments, and you want to ask, do we have a combined factor that is driving both products? If no, you want to forecast them directly. I think at this point I will stop a little bit, because I think I've been talking for a while, just to be sure everyone can hear me, one, and two, if anyone asks question that I might quickly address.
Thank you, Damilola. And just to note, I understand that a lot of students on this core are likely not finance or business major, so you probably don't have exposition to accounting. While some other accounting students, and I also can confirm there are a few chartered accountants on the core that are students anyways, but for the sake of those who are struggling with some of the nomenclature that's or terminologies that Damilola has used, things like MPV, revenue, I won't be surprised, if there are one or two persons or a lot of other people that are not familiar with these terms. So what we would do, just continue to follow the training with an open mind. Ask questions if you have any. What we'll do after the training is to also share with you. I think we should have done this earlier. Share with you a few resources that we think will be helpful for you to sort of understand or be able to put a lot of other things into perspective. As Damilola has mentioned, I think decided to use this session today to, explain the basics preliminary to you all. That gives you ample time to also then go back, do your additional research, understand better the things he had mentioned. I think it's important that you take notes of those terminologies that you're not familiar with and see this as another um, ECHO or ECN or class where the professor had come into the class and you look confused with some of the context you have been introduced to. So essentially, we'll be providing you with information, additional information that will guide you. I think we're in discussion with Society Office to see if we are able to create like a WhatsApp group for you guys where we are able to share some resources we might not be able to send to you via the society office. We might be able to share some resources to you directly, that would help you achieve those little understanding. So that Lola, we have, and I think I also noted a few other things there. Yeah, so again, that Lola, just to note that they had their company visit, I think sometimes towards the end of last month. So I think that has been. Can you hear me, Damilola?
Yeah, I can hear you.
Okay, they've had that company visit towards the end of last month. I understand them. That has been heard, and but just to note to all the participants that should you have any specific questions for the company, I think society is always open to taking. If you can compile all your questions, maybe after all the sessions, there are a few questions that you think the company is in the best position to provide for you. You can compile all your questions together and send it to the society office, right? They will definitely find a way to, make it a bit more comprehensive, narrow it down, and then maybe share with the company to provide you some responses that will guide your analysis. You can't do this challenge without having enough understanding. Even the research analysts out there today, for them to be able to do their work efficiently, they continue to engage with the company investor relations office, to have more information, ongoing information, clarification, and you have to be able to do the same thing. And I think the subject company will be more than happy to provide ongoing support to everyone. So a few questions in the chat box, Gabby, and I will just try to take them one by one over the next 5 minutes. I would think if we can take a 10-minute break after we take all these questions, and then we can come back and start where you stop. I think the first question is, so when we segment sales, what does it mean? Does it mean we prepare? I think maybe the question is, does it mean we will prepare different income statements? I guess what Princess is referring to here is when you refer to revenue segmentation, probably when the subject company has different revenue line. Do you prepare a different income statement or do you model them separately? Maybe how do you think about it? And Princess, in case that question was not captured appropriately, please do well to indicate interest to speak directly so that we can allow you to just speak directly. But that's the way I've read it. So Dami, do you want us to go through all the questions for us, or you want to take it one by one?
I think I'll take it one by one.
Okay, please go ahead.
Okay, yeah. So when you talk about segment analysis, basically, right? So when you start doing your model, right, you will have, we are going to talk about how you structure your model, but you definitely have what they call an input sheet, or you have some what they call supporting schedule, supporting sheet that would all flow back into your actual, three three statement model, right? So when I'm talking about segment analysis or segment sales segmentation in this case, what I mean by that is that when a company has about more than one product, right, that they are selling, and they are driven by different things, or you want to forecast it in different ways, you don't necessarily have to have two different income statements. What you just need to do is go to your input sheet, or you might have a separate sheet, where you break down the Okay, let me see if I can quickly, let me stop sharing my screen for a minute there. Right. Okay, let me share my screen. Sorry. Mm. Can you see my screen? Can anyone confirm
Yes,
that you can hear
yes, we
me?
can. Damilola.
Okay, good. So basically, I was going to use this particular, um, tab to just explain a quick one for you. But this is what it might look like. Of course, this is not granular. This is just something very basic. Let's say, for example, your subject company has, let's say, premium segment, standard segment, and they are also into marine and protective coating segments, like in terms of like different kind of paint. So in this kind of situation, the company would, in your financial statement, the company would have given you a sum of the revenue they made. Let's say 2023, we made 100 naira or 100,000 of sales, right? But they will tell you that 100,000 in the premium segments, we're able to sell 50,000 like of premiums of Dulux in this case in the premium segments. We're able to sell, let's say 30,000 in the standard segment, and in the marine segment, we're able to sell 20,000 of paint. So by the time you add all of this thing up together, it sum up to like the 100,000 that the company make in sales, which will be here. We are going to, when we get, okay, this is not the completed version, but we are going to have that income statement in your revenue line item, for example, that will show the final amount. But that final amount is going to be coming from your input sheet, which you would have, model out. So historically, you bring out the revenue segments by segment, then you look at what is driving it, then you then model it out. So by the time you model it out, the sum of all of those revenue of those products is what we're going to take into your actual income statement, which you are modeling. So you don't have to like do two different income statements, because there's only just one company at the end of the day who is going to report just one income statement. But in the income statement, they would have done a breakdown. I don't know if that answers the question, but if it does not, you tell me, and I'll be happy to like say more about it.
Thank you, Damilola. I think I mean, like as I mentioned, Princess, if you probably would require further clarification, right? We are happy to take that probably down the line. But just to move to the next question. In a case where companies don't provide some information like drivers of cost, breakdown of raw materials, and so on, which of course, in most instances they won't provide.
Of course.
Is there any way one could, ease the issue? Well, you have not, um, Abdullah Shukura had not stated the issue, but I want to assume that she's talking about aid, those the in terms of your projections and drivers. What I guess these are things that you're going to be getting into, Damilola, correct? So maybe we can let this question go for now, and in case Shukura, in case Dami does not cover your question after he's done with this session, you can, just bubble this question back on top of the question trail, and we can pick it up from that. I think the next question from Jonathan, uh, please, what's the difference between a pro forma income statement and an income statement? Dami, do you want to take that?
Yeah, sure. But before I take that, I will just answer the first question quickly. I will still get into that, but I would keep it very short. So when you are thinking about input, right? So all your input is not going to be coming from the company. The company is not going to feed you with all the information. And to be very honest, all the inputs that will make your forecast, your model to be very sound is not going to be coming from the management team alone or the company alone. There's going to be a series of data you're going to be using. Let me give you an example quickly. Let's autos, for example. In the automotive environment or the automotive sector, there are some data provider, for example. I'm trying to remember the name now. There's some data provider that provide production data, sales data. They'll give you a breakdown of the number of cars that is produced globally on a monthly basis sometimes. Sometimes they could do it on a quarterly basis. There are different data provider, people that, they will look at, how many cars are sold globally. They will do it by they will do it by countries. They could also do it by model, like the number of Teslas, for example, that it's been sold in Europe or in Asia or in China, in Nigeria. They will do that breakdown. A company that is probably producing cars also in Nigeria. If a subject company, for example, is producing car, right? They may not necessarily give you that granular detail of this is the number of cars we sold, but there are some data providers that provide some of these input sheets. So and that is where your research skill. You're not just looking at the company, you're looking at a lot of things, right? You would definitely look at other macro data, whatever data that will come in together to make up your input. So like something said, probably when we start doing the model, of course, it's a very simple model, but I'll kind of like, go back and touch all this, these points, and you'll be able to like see how that could play out into a model. Question. And so the pro forma income and income statement. So basically, pro forma is basically something you are preparing with, with something that is not the actual. Like this is not. Let's say a company releases their Q3, for example. Your subject company has released their Q3 results. That's actual number. That is what the company has done in that particular quarter. But when you are forecasting, right? So you are going to be using some of this historical number, and also going to be some future guidance of what you think the number is going to look like. So but when you hear the word pro forma, it is not the actual income statement. It is not the final figures. It is just what we are. It's the assumed number based on a lot of things. So just see your pro forma income statement as your own version of the analyst version of the income statement, or what we think the income statement is going to look.
Yeah, thank you, Damilola. I think that so the next question is how do we get data of sales of a company? So Princess, if your question is how do you get data of the breakdown of the sales, again, I could just provide a response to this. For a public listed company, we are required by the provisions of the challenge you are into, the research challenge. If you read through the challenge manual that was released, you are required to only operate with data and numbers that are publicly available, right? So if the revenue number is not provided in their income statement, and which of course I'm sure you know how to get on the Nigeria Exchange platform, if their revenue numbers is not provided, then you have to, the breakdown of their revenue is not provided, you have to work with what is provided. So typically you get that data from their financial statement, right? But in case you are trying to ask the question in another form, again, please try to clarify if the response is not sufficient. For companies who do not release the revenues, they release the revenue segment. How do you segment revenue? Kamala, do you want to take that? For companies who do not release their revenue segments, right? How do you segment revenue?
Oh, that's a very good question. So in most investment houses, right? And I'm not going to be using my employer alone. I'm talking about like generally, there's what we call proprietary database, right? Some analysts build their they build different kind of like input by themselves, and over time it becomes something that they tend to use, that it becomes very valuable. So if a company, for example, is not maybe bringing down of their revenue, right? It is two things. It's either you could do, if the analyst could do a reverse or an engineered way of like breaking down that segment based on available data that is available publicly. It could be that, you know, there, like I said, I think that after I mentioned the fact that the data provider that provides certain information and whatnot, the analyst could scrap information from everywhere, and that particular data becomes something that by the time they do a reverse analysis, they'll be able to get the total value of that sales. That is not that. So the company should report their segment breakdown in their public or in their capital market day. Sometimes it may not be something that will come with the actual financial statement. They could be having some other presentations that they'll be releasing every now and then, but it may not be frequent. It may not come with the financial statement. So you want to look all through the available financial information about the company from the company itself and from other data providers. So, but you knowing the actual data provider to use, or you knowing the actual data you can use to do a reverse analysis to get the actual value is something that requires skill set, that requires experience, that requires you being familiar with that industry and whatnot. So it can be a little bit tricky. But if the company does not have a segment breakdown, you don't have to overstress yourself if you can't get it. You can still do your analysis, especially when the company is in probably matured phase of their business cycle, or you don't expect a lot of changes to happen with the company, and the management is not kind of guiding around that there's going to be some massive difference in how the company is performing. Then most likely the historical will give an idea of how the company will perform over the years, and of course that's when you bring in your additional macros, like macro and industry expectation into the number to say, okay, yeah, if GDP continues to grow at this particular percentage, if inflation is continuing to stay at this particular percentage, if competition continues to if the company continues to achieve this particular market share, compared to competitors, you expect the company to be able to continue to have certain number of to make a certain number of sales year on year. If you think if GDP is growing, for example, what that means is economic economic prosperity. People have more money to buy whatever it is the company and it comes back to having an understanding of all of this thing plays out, and you'll be able to kind of a reasonable opinion of what you think the sales will look like next year and going forward. So it is not a it is the that is why most of the time analysts are always asking management question. Sometimes this question might even be something that the analyst would ask on during the earnings call and whatnot, to say, oh, could you give us a color of what makes up your sales? Could you tell me what's the percentage of this particular segment? And the management will hint on it that, okay, yeah, we're able to make 80% of our revenue from this particular product line and the rest from the other. So that information alone could make a difference when the analyst is making their own analysis, because analysts tend to have their own proprietary database. They have their own proprietary module that they build that supports the financial model itself, that supports the whole process itself. So it's not just the financial model that the analysts use in making their final decision. They look at a lot of database, a lot of stuff. I don't know if that answers it.
I mean, thank you, Damilola. Again, I think you've captured the key pointers to just say that when revenue segment is not provided, you don't have access to it, Emmanuel. Unfortunately, some of the proprietary data that Damilola had referenced, you would have access to those proprietary data sources. I think maybe you have access to, I don't know, in our time, we had access to Bloomberg. I think subsequently there was access to Reuters. I don't know what access has been provided to you this year for this challenge, but usually most of those segment numbers are kept in-house by a lot of research houses. So you should not bother yourself about it. If your subject company does not have revenue segment, I think you should just proceed with what has been provided to you. Go to their notes and make best of the information that has been provided. If you need further guidance, you can always put together your questions and I can advise, send societies of it and see if they can get responses from the company for that clarity. I think the next question is on if operating profit is same as EBITDA. I think there's been responses to that already. That yes. But however, I would say I think the way you should look at it, Tijani, is EBITDA is a form of operating profit. There are other measurements of operating profit. Your EBIT could also be taken sometimes as your operating profit and also. But again, in this instance, it's correct to say that operating profit is equal to EBITDA. It's correct to take EBITDA as a form of operating profit. I think that those are the questions we have, Damilola. Maybe we can take like a short break now to also allow you to get a cup of water. So maybe we can go for like a 10-minute break and come back, say by 10:50. Yeah, we can come back by 10:50 to really just consider what's the second half of
just a quick, sorry, something. Just a quick one on this EBITDA question. So I don't know, but when you think about EBITDA, you also like need to like just look at what makes the breakdown, right? So when from an analyst perspective, right, you look at EBITDA more as a proxy to cash flow rather than more of like an operating profit. Because when you look at the element that makes up the EBITDA, it is typically the earning before interest, tax, depreciation, and amortization. And sometimes the argument for and amortization, because why you consider EBITDA and operating profit when you can confirm that the depreciation and amortization bit, is not an operational expenses, but most of the time it is. So that is why sometimes when you look at company breakdown, sometimes in the cost of goods sold, you will see things like SG&A, for example, or you could also see another form of depreciation. So the company was trying to do that. There's some kind of like depreciation that are more relevant to the operational bits, or that are kind of like related to the company being able to generate revenue, and that's why they'll kind of like split that kind of like depreciation into two. In that kind of situation, EBITDA, yeah, you could argue that it is an operational profit, but generally, like, it's generally more acceptable. Or the better way to think about it is like to look at, like Samson said, to look at the EBIT, which is like the earning before interest and tax, because at that point you've captured all the operational costs, and that is why you see that here. You see the sales, you see the cost of sales, then you see the gross profit. But the sales is one bit of the operational expenses, but the cost of sales is more of like the actual cost you incurred for you to be able to like generate that sales, right? But the operating cost, the other bits, the other kind of like expenses you have to incur, advertisement, wages, for example, salary, which consists like the major bit of like the operating cost. But every other kind of cost that you've incurred as a result of you being able to like function as a company, what goes into the operating cost, and that is why you're seeing operating profit. When you now take from your operating profit, which could, you could, if the company, let's say for example, does not have depreciation and amortization, which is definitely not be the case, you can call a bit that operating profit. But by the time you factor in depreciation and amortization, for example, and you are out of all of the costs that you've incurred as a result of you being in business, then what you are non-operating costs, some other kind of costs you might have incurred that are not necessarily because, they're not necessarily related to your day-to-day. So, you could have, like, let's say, financing income, financing costs, taxes, all of these things are like non-operating costs. And you could also have some kind of like costs that are not even relevant to the business entirely, but maybe you've incurred them, because you were doing every other thing outside of the business. So all of those things will come into the non-operating bit. So just to be careful, when you kind of like just, EBITDA, yeah, it can fly, but you need to like also know that what we call operating profit, it's more skewed to like the EBIT, or the earning before interest and tax. So that way you've captured all your operational costs.
Thank you, Damilola. Thank you. And again, as Damilola, as we have continued to reference, what we're trying to achieve with these conversations and sessions is to provide you with those guidance and basic understanding. You will need to go and do additional research just to also own your own understanding and own your own knowledge so that you can speak to it at any point. So as discussed, we take a 10-minute break now. Well, we've taken additional 5, so I guess we'll be back at like say 10:55. Please take time to get water, maybe get some breakfast, and let's meet again at 10:55. Thank you, everyone.
Sam. Hello, can you hear me?
Yeah, I can hear you.
Give me your
All right. Again, good morning again, everyone. I think we can commence the second half of the session for this morning. Damilola, confirming that you are ready to proceed.
Yeah, sure thing.
Thank you, Damilola. Okay, so I think you can proceed. You can share your screen, please, and continue. Thank you.
Okay. Minute. Right. Okay. So thank you, and welcome back, everyone. So I'm going to like just do a quick run through on this pro forma income statement and the other statement. Then hopefully we'll try to like see how far we can go. So right. So this is pretty much how your income statement looks like. So you've got the sales and you've got all of the the costs you have to incur in being able to achieve that sales. And of course, like from there on, you see the first line of profit, which is gross profit, right? And by the time you start doing analysis and whatnot, your gross profit is like the first kind of profit you get to like see. And this kind of like tells you how the company is performing, from a cost perspective, like from the direct cost perspective. So if the company is making $100,000, for example, in sales, and the company was, had to incur almost like, let's say, $60,000 to be able to like achieve that sale, like it's buying the stock, all the direct costs involved and whatnot. So the gross profit they make is like the first profit that they make as a result of like making that sales, right? Then from there on, you have some other operational costs, and other operational costs I think I've mentioned earlier is that those are the other costs that are not necessarily they're not directly related to you selling the product, but they are the costs you have to incur in being able to achieve it. Less advertisement, you have to pay salaries, and you have to pay logistics and whatnot. So all of the costs that are directly related, that are operationally, that you can operationally link to the business activity, those are your operational costs. So by the time you factor in all of those, then you get to the operating profit, which someone asked earlier, which is usually like your earning before interest and tax. But the thing is, when you think about a company, or when you think about your subject company is mostly financing just two ways. There are only two ways of financing, pretty much it. Every other thing is just building around it. Is either you're being financed through equity, like your shareholders or people who own the business, bring in the money. And sometimes, you tend to like, have debt, holders, also like people that provide you loan, giving the business the kind of like source of financing. So when you have that kind of situation, it tends to like result in things like interest expenses. And when you think about interest expenses, basically when someone gives you if a source of when a source of finance, all sorts of finance tend to ask for a return, right? So there's an amount you are paying as a result of utilizing that particular fund. So from a debt perspective, that particular amount is factored in as your interest expense. For shareholders, like in the hierarchy of when a business, for example, liquidate, or when a business goes into trouble, so there's a there's an hierarchy of who should get their money first, and debt holders are people that would likely get their money first. And most of the time, we look at how much exactly are we paying to even finance, to how much are we paying as a result of the loan that we've incurred. That amount is what they call the interest expenses. So every other amount at the end of the day, that every other profit we make after factoring in everything goes to the shareholders, which is the net profit. But apart from finance costs or interest expenses in this case, there's also what they call interest income or financing income. And this is when the company has enough cash, like enough, they have excess cash. They were able to like, make enough money that, they probably like are investing their cash or cash equivalent investment, and they're probably generating a few income from it. The quickest example is when you have your money in a savings account or a current account, or in a savings account in this case, and the company is paying you interest on your money. So that's kind of like money is finance income for a company that has that has a huge amount of cash that is probably invested in either invested in cash equivalents like security, or they are sitting in the bank and they're getting some some interest on it. That money can be significant. So that's finance income and finance cost. By the time you deduct that, you have your profit before tax. This is pretty much, by the time you look at your subject company, for example, you most likely see this kind of breakdown of the income statement. Sometimes there are few differences when you look at different companies. Different companies they tend to have different line items as a result of the kind of business they do and the kind of activity they engage in. So you need to be able to ask yourself, what are operational expenses and what are not operational expenses? For the sake of modeling, as an analyst, most of the time we are more concerned, or you should be more concerned about the operational aspects of the business. So there's some one-off costs. Let's say restructuring, the company is restructuring, or the company pay off some one-off, litigation costs or something that is not necessarily relevant to the business at all. These things are one-off. They are not recurring. They are not operationally relevant to the business. From a modeling perspective, you don't need to forecast them. You don't even need to think about it. Let's say, for example, the company has been running into trouble for the past 3 years, always paying legal costs, always paying, maybe there's some one-off, write down some issues that probably involve them spending money, not as a result of the activity they are doing, not as not as a result of the business they are doing, some ever that thing that has caused them to expend money. When you see that in your financial statement, let's say for the past 3 years, they paid legal costs in 2021, they paid legal costs in 2022, except you know with certainty that the company is going to pay this particular amount in a particular period, then you model it out. But if the company, has probably run into trouble like some previous years ago, and you can't foresee, with the possibility of them incurring any legal costs going forward, maybe there's no court case and whatnot, there's no need for you to forecast legal costs, for example. What you should be focusing on is the operational bit, because that is what really constitutes the value of the company stock, right? So you focus more on the operational bit. So you ask yourself, what are the operational aspects and what are the non-operational aspects? For financing costs and financing income, or interest expense or interest income in this case, those are the things you need to model out, especially when the company has debt in its book, the company has loan, which they will most likely disclose in their balance sheet. And of course, you have to model this out, because these are going to be ongoing expenses. These are mandatory costs you have to incur as a result of you getting finances from loan. So you have to model this out in that case. The same thing goes for financing income, especially if the company is going to keep having cash. But in the case where you think the company is going to retire all of its debts in a particular period, then you need to model it up to the point where you know that the company is not going to pay any loan. But most of the time, the company tends to use a lot of debt, so you most likely see finance costs and finance income in your books every now and then. So you need to model that out. Taxes, for example, the company continues to pay tax. Of course, there are cases where the company will benefit from tax credit, maybe tax break. The company is probably your subject company is in an industry where the government wants to support, where the government wants to encourage more business activities to come in. They could give tax break, and that could impact the amount of taxes the company pay. That's where you hear the word effective tax rate compared to the mandatory tax rate, or in this case. So those are the things that are relevant as far as the income statement is concerned. At the end of the day, the bottom line, like I said, the bottom line is profit, right? We want to see that at the end of the day, as a company made profit or as a company made loss, right? And that is the end goal. That is the bottom line, and that's how you can see all of this breakdown here. And from an earnings perspective, you want to look at the amount of profit the company has made how much does it translate on a per share basis? So if you are going to be sharing that profit to all the number of ordinary share the company has, how much does it worth? And that is what brings us to like the earning per share. So that's pretty much what the pro forma income statement looks like. The next thing is the balance sheet. So I will try to like just keep it short here. So your balance sheet basically is showing that how much money, how much resources does the company has, which is like your assets. So the company has a particular asset, and the company also like has some particular liability. So you tend to like use the money you raise from equity and from debt to purchase assets, right? And that is why we call it the uses of company funding. We use the money we raise in buying assets, building capacity and whatnot. So we are going to get in the breakdown of that. Non-current assets, current assets. Pretty much when you talk about non-current assets, these are assets that are like you expect them to be with the business for more than 1 year. Current asset like your inventory, your receivables. These are also like the resources of the company that, but you expect them to be converted into cash, within a particular accounting year. So same goes to your current liability, your non-current liability, and at the end of the day, you have your equity, your shareholder equity. All of these things will do a proper. By the time we start doing the proper modeling, there will be more breakdown than this pro forma. Then your cash flow statement, like I said, this shows when you think about cash flow, I think anyone, even if you're not an accountant, you'll be able to kind of like understand cash flow, because it's pretty much, did cash leave or did cash come in? So anything that will, you would involve in that will make the cash, go out of the company is an outflow. And anything that, you do and you get cash for is an inflow, right? So we usually segment cash flow into three. We look at the operating activity, the investing activity, and the financing activity. From an operating activity perspective, like it's pretty much like the word it is, operating. So the cash element of your day to day, basically. So how much have you been able to raise in terms of cash from your normal day to day activity? That's pretty much your cash flow from operating activity, and it is from this. This is like pretty much the more important part of the cash flow statement, because the amount of cash you have at the end of the day, at the end of your operating activity, is what you have to probably like buy assets or buy additional or build factories or build more capacity. So the operating activity is something that analysts tend to pay a lot of attention to, and this is something you also want to pay attention to. So your operating activity, the investing activity is pretty much things that your investment, things that the company invests in. So the company is into capex, buying things like capex are things you are going to be seeing there, and also and when you talk about capex, if the company buy capex, right, cash goes out. Or if the company is building factory, cash goes out. But if the company is probably like selling one of the assets, maybe they're disposing a particular business segment that is not really profitable. In that kind of situation, proceed will come in, right? So you sell an asset and you get cash. So that's pretty much investing activity. Financing activity, like I said, the company might be raising new debt. The company might get additional flow from the shareholders, and these are inflows. And the company might be making repayments, like paying back. They may be paying back their loans, and this is going to be an outflow. So just think about it from inflow outflow perspective. And by the time we get to like the cash flow statement in modeling, you tend to see like how it makes more sense. So by the time you aggregate it, from the cash flow from operating activity could be positive, it could be negative. Most of the time, when the company is having a negative operating activity, that's something that you need to pay attention to, because if the company is not making enough money from its day-to-day operation, then what that means is that the company will be forced to borrow, right? The company will be forced to raise fund, either from the shareholders or from the debt-to-debtors, and that is, you tend to see probably the financing activity negating this particular one. And if the company does not have enough money, the investing activity could stall. But sometimes financing activities could kind of like trade this off. in this case. But it is a good thing. It's a good thing to see that the operational part of the cash flow is positive. So that way, the money will be enough to, like, it will be enough to, like, carry out any activity on the investment side of things, because the company continue to grow, right? If you are expanding, if they are building more factories, if they are doing, taking on, probably like acquiring even another company. So all of this will involve, like, enough positive cash flow coming from the operating activity. So I won't take too much of time. So basically, when you look at how much do you have initially as a business, then you look at the net, you look at the cash you're able to make in the financial period. By the time you add that to the amount you have before, you're either having an increase or a decrease, because cash flow could be negative, it could be positive. If the company is not, like, making enough money from operation, it could be negative from there, and that could affect your financing and investment activity. So if the company has enough cash as a buffer initially, that could, what we could be seeing is, like, we could see a decline in cash at the end of the year, or we could see an increase at the end of the year. So these are the things that we'll discuss. And of course, if the company does not have cash, the company will be forced to probably, like, get into, like, their line of credit. We call something a revolver. By the time we start doing the modeling, you hit the word like revolver, revolving credit. So the way you think about revolving credit is pretty much, a line of credit that's available for you to take advantage of. I will use credit card as a way to explain it. So if you have a credit card, for example, you can easily, spend money on a credit card, but you don't have to pay it immediately. You can pay it later. So that is why we use revolver as a plug for our financial model, which we'll get into. So that's pretty much on what the three statements looks like. Now, to the more important point, which is, like, how does all of this thing links together? Right. So when you're preparing your model, you have your income statement, you have your financial, you have your balance sheet, you have your cash flow. By the time you already have, you've replicated all the financials in your Excel, right? You want to start modeling. And the first thing you need to do is you pick up your financial statement and you put in the historical number. So probably, like, you might be going 5 years back, you might be going 3 years back. So let's say you take, your 2020, 2021, 2022 financial statement, and you put it there. So by the time, because you are doing the historical number, you may be tempted to just put in the number, in the income statement, you just put it as it is. And if in the balance sheet, you just put it as it is. In your cash flow, you just put it as it is. But you can start your modeling process from your historical number. And the way to do it is to be sure that you are already linking your financial statement from the historical number. Sometimes there can be a little bit of, issue. And this is when the company is probably, like, having a restatement statement. Maybe the company reported, you might see $100,000 in 2022 financial year when they reported. By the time you look at 2023 financial year and you look at that same line item, that line item could be instead of $100,000, it could have moved. You could see something like $101,000. Then you start asking questions, or you start having some little bit of confusion of, why am I seeing two different figures? That's because most of the time the company do what they call restatement. And when the company is restating, the better way for you to go, or the way you should put in your historical number, should be that you should use the more recent financial statement to put in your historical number. That's the way to save yourself the trouble, because you might encounter it, you might not encounter it. It's a possibility that, it might be just one line item, it could be a few line item that's being restated. And the better way to go is that when you're doing when you want to put in, let's say, for example, your 2020 financial statement, you should not use your 2020 annual reports or your 2020 financial statement, the company 2020 financial. Don't use that to put in your numbers. You should rather use your 2021 financial, your annual report, or wherever you're picking it from. Use the 2021 statement to put in your historical, because that way, if there was any restatement at all, you would have been able to capture it, because you'll be using the more recent number in your modeling exercise. And like I said, your historical input, your modeling literally starts from there. So rather than you just putting the number as it is on Excel or copying and pasting, our advice personally to start linking it. So, and the way to link it is like you also having an understanding of how all of this thing even like, links together. So, linking it could be that, you are looking at your revenue, for example, and you are like, instead of like, when you get to your gross profit, instead of you like doing, let's say revenue is 100, cost of sales is 60, then your gross profit is 40. That's how it is. The company has reported it. So don't put 100 in your revenue line item. Don't put you put your 100 in your revenue line item. You put your 60. But when you get to your gross profit, I think the better way to do is to just like do the actual formula rather than just putting the actual number. Yeah, it is the actual number true. It's the same thing, but start linking it, because by the time you want your model at the end of the day to be dynamic, right? You want it to be, you want any changes that you make so that when you make any error, by the time you are following through with the way the company has presented and you're adding up when you should add, you are linking where you should link. By the time you are getting to your total, if it does not equal, if your total does not equal to that of the company's actual reported figure, then you'll be able to quickly know that you've made a mistake. Because if your historical is wrong, this is what you are going to be basing your analysis on. This is what you're going to, this is your first point of analysis, as far as the financial, company is concerned. So by the time you get that wrong, then it fits through into your forecast. So link up your historical, use your sum when you need to sum, like the balance sheet also. You can just ensure that, like, just be sure that the cash balance, for example, in 2021 is the opening balance, in 2022. The net income in your income statement is the same net income, that is showing in your cash flow. So you want to see that the depreciation, for example, here in the income statement is also the depreciation in your cash flow. You can do this by linking your historical. If you don't do it, it's fine. It doesn't make any difference as far as like when you're making the input, as far as you are being careful, you have that attention to detail and you put in the right number, it's fine. But the sanity check for you, why you are doing it, because the thing is, when you start modeling over time, when you start looking at the model, the number looks so familiar, up to the point where the wrong numbers can look so familiar because you've seen it so many times. You close it to, maybe let's say you put the first 3 years, you close your laptop, come back to it tomorrow, and you continue. It becomes familiar over time, and it will be very difficult for you to spot your error. And there's also the possibility that one of your team member might help with 2020 data. The next team member that is picking up that model will find it very easy for them to continue to build the historical if you've done the right thing, right? If you've, structured your model in a dynamic way, if you've, used the formula where you should use it, if you've linked where you're supposed to link it up, that would be great. But if you've not done so and someone else is just, probably like picking it up, there could be a lot of mismatch. There could be a lot of errors in your historical model. Like I said, garbage in, garbage out. By the time you're making error in your historical, then there's no point again, because your model, your forecast here is going to like be filled with a lot of errors. So you might want to give the historical number, or like someone, you might want to give the, I don't want to use the non-financial person, or somebody that you just feel like, yeah, this person is just part of our team. You put the historical, we will do the model. You want to give the person that has the most attention to detail, the model, the historical, to like, to do the input. So the links between the financial statements is that when you look at the 3 statements, they are individual, but they are working together, right? So when you think about revenue, let's do a little bit of like example. So when a company buys, or when a company sells their product, when they sell, let's say your subject company sells their, I don't want to use a subject company. Let's say a car maker sells a car, right? Well, let us use your subject company. Your subject company sells a paint, or a number of paints to their favorite customer, or the particular customer that that frequent them. It could be a wholesale, it could be another, like another business. So when they sell when you sell their products to their customer, two things can happen, right? Or about three things can happen. Is that your customer pays you in full, or they pays you 50%, or you pay a proportion of the total and tell you that they will come back to pay the rest, or they promise you that they will come back to pay everything and not pay you immediately. Now, of course, like you don't want to be selling to someone that is, keeps coming to say we are buying everything, we'll come back. Sometimes on business model like allows that, but in most situations, you want to, have that reasonability of you have some customer that is bringing cash so that you can continue to run the business and whatnot. But those are the three possibilities. If a company pays you cash, like accountants, like you recognize recognize the revenue because you sold the products, right? But because they paid you cash, that cash will go to your balance sheet, right? So you recognize that you've received that cash and it will reflect in your balance sheet. So let's say you have it, and the way your balance sheet is you might have, let's say, 100,000 in your balance sheet as cash. So when you sell another product for, let's say, 50,000, that 50,000 increases the value of the cash sitting in your balance sheet, right? And you also have the revenue like reflecting that in the income statement. So that is like a relationship. But if the company, for example, or if your customer in this case tells you that I'll pay you a proportion of the total and I'll bring the rest, what that means is that, of course, you recognize the whole of your revenue because you've sold that particular product. But the way you're going to recognize the payment structure is going to be different in your balance sheet because you've received part of it as cash. So the part that you receive as cash will go to your cash, the cash line item in your balance sheet. But the part that has not been paid, even though you've recognized the revenue, will go to your receivables because that means there's a debt in your balance sheet, which is also part of the current asset, right? So having to that create a relationship between the revenue and the receivables. So by the time you are thinking about modeling out your receivable, you will think about it from a revenue perspective to say, oh, okay, if this is my receivables, I'm seeing, let's say, 20 in my receivable, and I'm seeing 100 in my income statement. It has been, so that's typically about 20% of your revenue is always coming in as a receivables, right? So in that case, you can say if that has been the case for the past 3 years and it has been consistent, the company has been able to accommodate about 20% of the total of their product to be sold on credit, then you believe that going forward for the next 5 years, the company will achieve that stability. The company will, of course, except the company probably start when if there's more competition in the industry, the company might want to extend more of their product as credit, and that could impact the receivable. It could increase the percentage that they are accommodating for their receivables. But if you are not seeing that trend happening, I think, what you are seeing historically is going to continue going forward, then it makes more sense for you to say 20% of your revenue going forward will always come in as receivables. So that is the relationship between your income statement and the balance sheet. Now, that receivables you're also looking at, from a working capital perspective, when you think about working capital, basically you're looking at the money that you use in running your business. Sometimes, so when you have a receivable, before I talk about cash flow, working capital, let's talk about like the cost of goods sold. So when you also, as someone who is supplying or who is a manufacturer, you're not just selling, you are buying from someone, right? So when you buy from someone, when you buy from your supplier, there's also about the three things that happen in the revenue scenario will also most likely happen when you're looking at it from a supplier perspective. So you could be paying cash immediately you are getting all your inputs. You could also be paying a proportion of the total to the supplier immediately and promising to pay the remaining in a particular period of time, maybe 2 to 3 months. And you could also be promising your supplier in this case that you pay everything in 30 days. So in that case, what is happening is that you are going to be having, to recognize like, you've purchased some inventory, right? So you've purchased some goods. So those goods will come in as inventory. The portion of it that you sell is the one that goes to your, Okay. So I don't know if you can still hear me though, just to be sure, because I've been speaking for a while. Can anyone hear me?
Yes, we can.
Okay, thank you. Okay. So the portion of the goods you've received that you sell, it will be part of your cost of goods sold, because that's the portion that you sell, to make your revenue, because you sell and you put a margin on it and you get your revenue, right? The portion of it that you didn't sell will go to your inventory. Let's say you purchase, like say, 100 chemicals that you're going to use in producing your paint, but you're able to sell just 60. So the remaining 40 goes to your inventory. So the bit that you paid for would reduce your cash, right? Because you paid. The bit that you didn't pay for, you will pay at some point. So that is a liability and it goes into your payable, right? So you recognize it as a payable. This is something you will pay within the operating period. That is why they'll tell you that your current liability, is an amount that you are owing, but you expect to pay within a particular, financial year, which is usually 1 year. So you are promising that you'll be able to sell this particular inventory within that 1 year. Then when you get the money, you pay your supplier and whatnot. So that is also like another relationship, right? Interest paid, for example, I think I've mentioned this before, that when the company borrows money, it's not for free. There's always a cost to every capital you get, and these interest expenses would be reflected in the income statement, because for as long as that you have that debt in your books, like as long as maybe you borrow 100,000, which you are using in running your business, so and the person is saying 10% annually, so you are paying that 10%. That 10% is the money you are incurring as a result of you getting funding for your business, right? So that interest expenses goes to your income statement, and you continue to see the value of that debt in your balance sheet. If you don't pay that interest in that particular financial year, that interest becomes an interest payable, which would be added to your balance sheet also, because you're supposed to pay it. So the fact that it's reflecting your income statement does not mean it has been paid. So, but if it has been paid, right? So it also affects your cash flow in the cash flow statements. You see it in the income statement, and of course, like there's a bit of, if the company is also like paying a bit of the debt year on year, maybe they paid 20,000 out of the 10,000, out of the 100,000 in a year. That 20,000 will reduce the amount in the balance sheet. So there's a relationship. There's something going on between these three statements. It's not just standing all by itself. So you having a knowledge of how the relationship works is going to be what is going to help you in thinking about how you should model receivable, for example, how you should model your inventory, for example, because you have an understanding that if you have modeled out your revenue, you should be able to bring out your receivables from your revenue, from your revenue. Once you do your revenue, you can easily get to your receivable because there's a relationship. All you just need to do is to find that relationship, and we do that by doing a ratio analysis, looking at receivable days and whatnot, like sales turnover and whatnot. So, but of course, ratio is just helping you to see how the trend is moving. It is now your own insight and your own expectation about how you think the company is going to continue behaving going forward that is going to drive what percentage or what number of days are you applying on your revenue for your receivable. Same for your inventory, same for your debts. For your retained earnings, I mean, retained earning is always sitting in the books, like in the balance sheet, right? But retained earning is affected, by a number of things, but the more common one is net income and dividend, right? Let's say at the end of the period, the company make profits. Let's say in the first year, the company make profit 10. They didn't spend it. What that means is that the company has some choices when they make profit. Is either they use it in growing, they invest it back into the business, or they distribute it to their shareholders to say, oh, we've made this number of profit, we don't have anything to do with it, we want to give it out to everybody, the owner of the company, after they've settled out everybody, so they give it out to the shareholder. The other option, so they do that in the form of dividend and whatnot. The company might even decide to say, oh, we think we want to have more control of our business. So we want to buy some of our shares in the market. So they use something called share buybacks and whatnot. So those are the kind of options that you can do with your net income. But let's assume that the company decided to say, we made 100 in profits this year. what we have decided to do with it is that 60% of it will pay to shareholders as dividend. So they give it out to the shareholder. The remaining percent we retain it. So that amount is being kept. Next year they do the same thing. Before you know it, that retained earning will start accumulating. It is going to be accumulating in the balance sheet, but the portion that you are making year on year is going to be reflecting in your income statement as a net income. So, and of course, if the company is paying dividend, that's going to reduce the amount in the retained earning. If the company is not paying dividend and it's just net income, it's going to keep increasing your retained earning. So that those are like the like relationship that you can see from an income statement and retained earning perspective. From a cash flow statement perspective, of course, according to the accounting standard like IFRS and whatnot, they've given us an idea of how to present our cash flow, either the direct method or the indirect method. For the accounting student or the ICANN chartered accountant, ACCA students, this will be something that you are familiar with. According to IS7, there's a way you're supposed to present your cash flow statement, which is how most companies also prepare their cash flow statement anyway. So there's no need for you to overthink it. So, and what that means is that when you see the net income, the company is preparing their books on an accrual basis. And what that means is that an accrual basis is when you are recognizing certain revenue, even though you have not received cash, which is what I just explained. And you are also incurring certain expenses, even though you are now like due to pay a certain amount of money. Let's say rent, for example, you've not paid it, but you are still going to pay it, but you are going to recognize your income statement that you've used up that particular rent. So you are going to recognize that rent even though you have not paid it. That's an accrual basis, like way of preparing the income statement. And because you are preparing your income statement that way, in an accrual way, your net income does not necessarily mean that the profit you've made is what you have in the bank. So you might have a company might report 100,000 in profit, but that 100,000 is not necessarily sitting in the bank, right? So what that means is that there's some money that you're expecting to get at some point. Then there's also some money you're supposed to pay at some point. But by the time you net all of those things off, it will equate back into your net income. So, but because the cash flow statement only reflects the actual cash that you have as a business, you do all of these adjustments. So, and that is why your net income most of the time when you're doing the indirect approach, because we have the direct approach and the indirect approach. Most of the time, the companies adopt an indirect approach. So by the time you tend to adjust your net income because your net income has some certain things like depreciation, for example, is something that you recognize because you have an asset, and that asset is expected to use 10 years. But out of that 10 years, of course, you are going to use that asset in a particular financial year. So that portion of the assets resources value that you've used up in this year, you recognize it, but it doesn't have any cash movement, right? So you adjust your cash flow statement for depreciation, for example. So there's a lot of relationship. These are things that you have to take your time to read and study. You look at your financial statement, play around it. But by the time you are familiar with the relationship, you'll be seeing why this a particular line item is how it links into the balance sheet. And most of the time, also the company does what they call the notes to their accounts in your financial statements. When you download the subject company report, you see they'll have the income statement, balance sheet, cash flow. Then they will have the notes to the account. So in the notes to the account, sometimes they will do a breakdown of what constitutes your revenue. They will do a breakdown of what constitutes your receivable. And from there, you might be seeing some relationship also. So take your time to study, read up on the financial statement, read up the notes. And that is where you tend to see more explanation about how some line item came to be. And things like interest expenses, for example, the company might guide you on the percentage of interest they are paying on certain debts and whatnot. So that is pretty much it on the links between the financial statement. Let me see if I can take one more slide before taking question. Okay, let's take some question before because this is like the bit of the modeling part. Are there any questions? Samson?
Hi, Dami. So for now, there are no questions. I guess we can wait for like a minute to see if anybody has any question they could post. So if you have any questions, please go ahead and you can go ahead and share, for like they just chill for like a minute or so and see if we would get any questions.
Okay. In the meantime, I think I'll just continue. So if there are any
Yeah.
question, yeah, we can put it in chat box and whatnot. So now let's go into, you are familiar with what the financial statement looks like, right? You also know how to put in your historical. You have an idea of the things you need to do before you start modeling, in terms of like, the things you need to like figure out. You need to understand the business and whatnot, the industry, analysis on doing like a lot of like background, like talking to the management and whatnot. So now the question is, you are now preparing your model. It's time for you to build your model. Before you start at all, when you open your Excel sheet, there are some certain decisions that you need to make, and there's some certain principle you need to have at the back of your mind before you start putting in anything, especially the historical, before you start doing this, because the way you structure your historical is how your modeling is going to look like. So there's some key decisions you need to make. But before you start building your model, there's some when you think about a good model, there are some things that you want to do to yourself. You first want to ask yourself, like, the model you are going to be building must reflect the underlying business. And what that means is that you don't necessarily want to design or prepare your model in a way where it is similar in arrangement to how the company has built their model. At the end of the day, your model is an internal. It's more internal. It's something that it's not the output that you're going to use in presenting to like your investors or your whoever it is that is going to be reading the report. It is pretty much what is going to constitute your report. In this case is going to contain all of the things that you have in your model. So you're not necessarily like showing, except you are doing a peer review or whatever, you don't necessarily need to like, show your investor, this is the model. Of course, they want to see your model at some point, but your model is something that you want to prepare in a way where you'll be able to have a breakdown of how the business looks. You don't necessarily have to prepare it in a way where it is okay. When you pick your subject company, for example, there's a way they've prepared their statement. You don't have to replicate, how it is arranged. I'm not saying, like, of course, there's some certain things you need to like, you need to keep constant. You're not supposed to change everything, but you need to prepare your financial, do a breakdown in a way where anyone looking at your model will be able to have a fair understanding of how the business works. And an example of it is the segment analysis that we talked about earlier. The company will only probably tell you revenue is this, revenue is that. But when you are doing your modeling, you want to do a breakdown of that segment to say this is what constitutes the revenue. You may want to have some certain breakdown of certain costs and certain line items in a way where anyone looking at it will have a fair understanding of how the business works. So it should reflect the underlying business. And when I mean underlying business also, this also includes you not paying too much attention to the non-operating part of the business. When you have enough information about it, you should factor that into your model. But you don't want to spend too much of time on what do we think litigation cost is going to look like in next in 2 years for this subject company, or what do we think about restructuring, except the company is guiding on restructuring in probably giving a long-term strategy and whatnot. You don't need to think about all of that. You need to think about the core operational part of the business, and your model should be able to reflect that breakdown of that operational bit. Sometimes there's some model that don't even care about taxes, finance costs, especially when that particular business is predictable and whatnot. They only focus on the EBIT. They only focus on the operational part of the business, the income statement. So, but in your own case, of course, just ensure that your model is designed in a way where it reflects the underlying business. It is easy to understand. People always think that the more complicated the model is, the more smart you are being perceived. Not necessarily. The best model are usually very easy to understand. Of course, there's some kind of model, that they're just hard model. When you're building an LBO, for example, which you are not going to be building today, like some M&A, there's some kind of like model that are complex in nature, like the way they are designed, or the kind of like granularity of work you need to do. But even at that level of complexity, there are element of simplicity in it. So you don't have to like be an Excel ninja before you can build a model. It just needs to make sense. It needs to reflect the business. It needs to show what you think about the business performance, when you forecast it into the future. It needs to reflect your opinion, and your opinion has to be reasonable and has to be in line with, of course, not just consensus, because what makes you different from every other person is you beating the consensus, right? Beating what everybody's thinking. You are thinking about it in a way where anyone that wants to understand the business will be able to look at your model and get a fair understanding of how the business works. Easy to change, and that means it has to be dynamic. Your team member is traveling from wherever to Lagos or Abuja, or going elsewhere or going home, and now they are transferring the module to someone else in the team, and the person doesn't have an idea of how the module works, because by the time the person start making changes, the changes that they're making in the income statement is not even flowing into the balance sheet. It's not flowing into the cash flow statement. That means that particular module is not dynamic. But that means there has been some hard-coded stuff into your module. So where you can avoid it, avoid hard-coded formulas and whatnot. So it has to be very easy to change. Now, to the way you are going to structure your module, there are different approaches. Some modules, when you open them, you see the income statement, balance sheet, and cash flow statement just in one tab. So it's called the tower approach. So, or the tower structure, because it is vertical. So what you see is that you see a long line of rows, and you have to keep scrolling down from the income statement to the balance sheet. You scroll down to the cash flow. That is a vertical approach, which is one approach, right? It has its own advantage. It also has like its own disadvantage. And the other one, I'm just trying to like move this here so I can see myself. The other one is the matrix approach, or the horizontal approach, where in one tab, you have the income statement. In the next tab, you have the balance sheet. In the next tab, you have the cash flow. In the next tab, you have your input assumption sheet. In another tab, you see some schedule and whatnot. Like, it's broken down into like different tabs, but it's still one spreadsheet, right? So that way, you are going to be doing a lot of linking, a lot of back and forth, linking this to this. Most modules are like pretty much like matrix module, where you do your breakdown and people want to see it in different tabs, but it has its own advantage, and of course has its own disadvantage. And the thing you need to be more careful about when you're taking the matrix approach, when you're taking different tabs approach, is that your income statement, let's say you have 2001, you have 2001 in column F1, right? 2002 next, 2003, 2004. When you go to the balance sheet tab, you need to ensure that you are starting that year, that column F1, where your 2021 is, has to be column F1 in the next tab. Because by the time you start doing your linking and there's an error or something, your module is not, you're having some error, or the balance sheet is not like correct and whatnot, and you're trying to like audit it, by the time you look at the way you've linked it. So let's say your assumption sheet is separate, and you have 2021 in column F1. So when you have 10% there, and you are using that to link to your income statement, you need to have column F in income statement and column F in your assumption sheet being linked up. By the time you are seeing assumption G times column times F1 in your Excel sheet, that means that you're picking two different columns. So they can I think I would show you that when we get to the model. So so you need to like decide, do you want to take the tower approach, which is the vertical approach, or do you want to take the matrix approach? both goes both way. As far as you're doing the right thing, both will be correct. Then of course there's a sign convention, and sign convention here is going to be something like this. When in the pro forma, for example, as you can see in the pro forma, you have cash flow from operating activity, is showing X. Sometimes, well, let me use the income statement. Yeah. So the sign approach for your income statement, your sales here is positive, right? Your cost of sales, of course, it is a cost. So you're supposed to subtract your cost from your revenue. You can either not use the brackets, to show that it's a negative, or you may decide not to use the negative sign to show that it's negative. You can easily like leave. You can easily remove the bracket of the cost of sales, and by the time you want to calculate your gross profit, you just need to say sales minus cost of sales. But because you have it like this in bracket, or you already have it in negative, you can easily say sales plus cost of sales. So by the time you say sales plus cost of sales, because your cost of sales is already negative, so plus positive negative turns to negative, right? So you can easily add sales and cost of sales to get your gross profit, and you'll be correct. So you just need to be consistent in whatever approach you are taking. So if you want to have minus in the cost to show that it is cost, put minus. If you think, people that are going to be looking at this model are financial experts. There are people who can read the financial statement. When they say cost of sales, or when they say SG and A, they should be able to know that this particular thing is a cost. I don't have to put minus in my model for them to know. You can do that, but you just need to be careful that by the time you are doing your total, you are subtracting where you need to subtract, you are adding where you need to add. So level of aggregation, sometimes you want to break down your cost of sales in itself. Sometimes you just want to have just one cost of sales and just move on. Length of forecast, are we forecasting 5 years into the future? Of course, by the time you want to do your valuation, for example, most of the time you forecast 5 years, then forecast a terminal value because you're expecting like that business to continue to the future. Most times, like most industry, do 5 years, or most industry practice is 5 years. Some do 7 years, some do 10 years. But of course, your accuracy of forecast will continue to reduce as you move into like the forecast year. So it is easy for you it's relatively easy for you to forecast what will happen next year than you forecasting what's going to happen in the next 10 years. And that is why most of the time we tend to stop at 5 years, then we do a terminal value. So that's for length of forecast. So those are the kind of decisions you need to make by the time before you pick up your model to start, before you start preparing your model, your historical. So if you're taking the tower approach, and you are using that to prepare your historical, you can't use the matrix approach again for your forecast. So that means like you are going to use that. You have to be consistent. If you are using the sign approach, positive. If you are using a particular sign convention in your historical, you have to be consistent going forward. If you are using a certain level of aggregation, you have to consistent going forward. So, but at the end of the day, everything you are doing, you want to ensure that your model is something that anyone can pick up and will make sense out of it. And it's dynamic because let's say, for example, you're talking to your industry mentor and they tell you, oh, I don't think this particular, company is going to grow 5% in this particular year. Can you change it to 2%? Because it's, it's kind of like, it's more reasonable and it fits into like the macro expectation and whatnot. By the time you change 2% and all the income statement is changing and every other thing is not changing, then your model is not dynamic. So you have to like be very careful in the way you design your model. Yeah, this is an example of the income statement. I think I've explained a little bit of this when I was talking the other time. So like in the first bit of the example, you can see sales, cost of goods sold, then revenue. And I'm using the negative sign in this case for the three breakdown here. And I have my 750 as my gross profit. My SG&A, which is the other operational expenses. When I deduct that, I have my operational profit, which is EBIT, earning before interest and tax. And this is where when I was talking about your design has to reflect you should reflect the underlying business, where I'm saying that you don't have to prepare your financial your model in a way where it's similar to the way the company is preparing it. So in this case, for example, I also want to see EBITDA. Let's say the company does not really have an EBITDA presentation, but I want to have it. So I can bring out the depreciation from this particular SG&A. Sometimes you could see depreciation also in cost of goods sold, same as amortization. I can bring both of them out. So I'm bringing depreciation out as 25, amortization as 10. So since my EBIT was 375, right, and I want to get EBITDA, so accountant in the house, you know that EBITDA is EBIT before interest, I said EBIT, before interest, tax, depreciation, and amortization, right? So EBITDA is before we deduct depreciation and amortization, and EBIT is after we've deducted depreciation and amortization. But since I already have EBIT here, so that means EBITDA, I'm going back. So I have to add my EBIT to my depreciation. I have to add my depreciation back to my EBIT, and I have to add my amortization that I've deducted back to my EBIT for me to get my EBITDA, right? And of course, like non-recurring items, these are like non-operational expenses, like we were talking about before. Interest income, we add. Interest expenses, we deduct, and we get our profit before tax. Then we remove our taxes and we get our net income. Now, that is the first assumption. Another way is that you're looking at cost of goods sold, SG&A. When you go to SG&A, right, you want to have your EBITDA value. So that means you've not deducted your depreciation and amortization from this SG&A or cost of goods sold, right? So you have your 410 here. Then by the time you deduct depreciation and amortization, you have your EBIT and like that. So it's pretty much the same. At the end of the day, the net income is the same thing, but the way it has been presented is different. It's just to show some level of granularity and to show some line items that are relevant to you in your analysis. The last bit also like sales, cost of goods sold. So here I'm showing my depreciation almost immediately. And now look, this is what I was saying before, that sometimes there are some certain assets that you have that you can directly allocate that depreciation expenses to the cost of goods sold that are directly related to you selling your product. So sometimes you can have some bit of depreciation in your cost of goods sold, and that is why in depreciation here I'm seeing 25. So and after that time, by the time you adjust it, you have your gross profit, right? Then you deduct your SG&A. Then amortization is separate from depreciation, and it's more it has been split into the operational side of things. And by the time you adjust that, you get to EBIT. So pretty much, if you want to get to EBITDA again, all you just need to do is to do a reverse and everything. So at the end of the day, if you look at the net income, it's pretty much the same thing. So all of this is just to show you how you can the level of granularity of your income statement or of your financial statements. Another example is, by the time you want to prepare your model, you also have two options, right? The first option here, if you look at the first part of this Excel, you see that you have year 0, year 1, year 2, and the assumption for sales, assumption for cost of goods sold, and assumption for SG&A is highlighted separately in different columns. So, and your sales is now showing from column 8. So you can see that the first year, in year 0, you have 850, and you're expecting it to grow in year 1 by 2%. So you have to by the time you do 1 plus the growth rate and you multiply it by this particular 850, you get 867, and like that and like that. The same thing. So your cost of goods sold, for example, is saying percentage of sales. You are expecting that the cost of goods sold is going to represent 1%, it's 1.2% of your sales. So all you just need to do is 1.2 times your sales, and you get your cost of goods sold. Then SG&A, the same thing, then EBIT. So that's one approach. The second approach is when you have the assumption, being merged together into your sales. So your sales growth, I have it here. Then the sales came after, almost immediately after. Then your cost of goods sold, the same thing. But the issue with this particular approach is that by the time you want to sum it up in this second approach, you have to pick each of those line items separately. Instead of here I could have just summed all of this from column 8 to column column 10. That's SG&A plus cost of goods sold plus SG&A plus sales plus cost of goods sold. Since I've used negative here, plus SG&A will give me my 20 EBIT. But here in the second approach, I have to pick column 5 for sales. I have to add it to column 7 of cost of goods sold, and I have to add it to column 9 of SG&A. So it's just pretty much how you are presenting your financial statement. Okay, how do you build your formulas or the best approach? There are some. This is just best approach. It doesn't necessarily change a thing, but yeah, something.
Apologies. So there are one or two questions I thought we could just take before you proceed.
Okay.
And the first one is Princess has asked that when the company releases its financial statement, must we create a pro forma statement? She had referred to must we create a statement you listed. I believe she refers to the pro forma statement you've noted. So I guess the question is, even though the company has released, a financial statement that of course we can take and directly use for our projection, right? Must we recreate the statement in the way you've noted it?
Okay, so if I hear you correctly, the company already have a forecast year assumption of what the numbers are going to look like?
No. So I think the question is, of course, every company releases an annual report, a financial statement, an annual report or a quarterly report, yeah? When 2022, for instance, from 2023 and from 2020 to 2022 has been released, we have the numbers, the way it has been stated by the company. Do we need to restate or reconstruct it in the form of the pro forma form you've shared earlier, right? Is there a need for those adjustments to make it look the way you've created it? I think that's what the question. Do we have to create a pro forma when we already have the numbers from the financial statement that has been released? I don't know if you get what I'm trying to say.
Okay, the truth is you don't have to, right? So if you feel like the way the company has presented their financials, it fit into how you want to model out the company, there's no need for you to readjust or to rearrange. But if you think that you'll be able to better model out the company if you do that level of granularity of breaking down your line item, you can easily replicate. Of course, while you are replicating, when I mean rearranging, you are not necessarily changing the numbers. You are only rearranging how you think you want to model the company. Say, for example, you want to have a bidder in your line item, and the company does not they don't have that in the financial statement arrangement. You can easily create a line item and get your depreciation out and get your amortization out from your EBIT, and you get your EBITDA. So it comes back to how you want to model, how you want to prepare your financial model. So you don't necessarily have to do it in a different way from the company. If you think the company's approach is already, the company arrangement is already fine, and you want to model that way, that's also fine. I don't know if I answered the question.
Yes, sorry. Thank you. Yeah, I'm sure if Princess have any follow-up questions, she will put up. Then the next question is from Favor. She had noted that adjusting your cash flow statement for depreciation, does it imply making financial provision for the depreciation of immediate capital goods?
When you say capital growth, basically,
yeah. The economics to me wants to make an assumption, but I do not want to assume what Favor means. But Favor, if you can clarify what you're trying to say, but we'll wait for a clear question from Favor.
Let me just answer the question as I understand it for now. Or let me just give a general response.
So she has asked two questions. Let me just take both of them, then you can provide a response to it.
Okay.
Assume a company has a hybrid form of finance of equity and debt and liquidation of cost. How does it share its assets? I mean, assuming the company finances its, assets using both debt and equity, and then there's liquidation. How does it, share its asset? I believe she means sharing the asset amongst debt provider and equity holders. Yeah, I mean, please, you can go ahead and.
Okay, just to the second question, where it's not going to be relevant to your company in this case, except you have an information that we don't know. But like there's something called hierarchy to, like, when a liquidation occur, there are people that you are supposed to pay first, right? And your debt holder are like at the top. So there are different ways that they do all of these things. Sometimes it could be a case where they would do some restructuring, right? Where they would convert some of those debts into probably preference share, or they'll convert it into share, depending on what the debt holders agree with. Sometimes all of these things also take some court processes. So, but let's assume that the company is liquidating and they want to sell its assets. So there are people that we'll have some, set of professionals that will sell all those assets. When they sell those assets, the money that they recover from it, the first money goes to the debt holder. Then let's assume that the total amount of, let's say both the equity holder and the debt holder has, let's say $1,000, but debt holder has, let's say $400 out of the whole thing. So that means that they need to sell the asset. When they sell the asset, if they sell the asset and they need to pay the debt holder $400 out of it, if they're able to sell the asset for, let's say, 600, right? So they give the 400 to the debt holders, then the remaining 200 goes to the equity holders. If they sell it for a lesser amount, then all of the money goes to the debt holders. These are court cases. It takes some, like, processes, court, liquidation processes, and it's not something that I would say is within the scope of this particular conversation. But if you find yourself in that kind of situation, the debt holders are paid first. You sell the asset, they sell all the resources of the company, the cash, the receivables, they sell, also like the fixed asset and whatnot. Then they pay up the debt holders. But of course, before they get to that point, there's a lot of option before you get to that point, like, refinancing, restructuring and whatnot. So that's like on the bit of that. The second question I can't remember now is what's the second question, Samson?
Yeah, I mean, I think she had asked if adjusting your cash flow statement for depreciation.
Oh yeah.
Yeah, does it imply making financial provision for depreciation of? I guess the idea is, do you have to make provision for depreciation?
So the thing is, your cash flow statement basically is reflecting what is in your income statement and your balance sheet. So in the case of depreciation, for example, right, you have an asset, and the asset you have in the balance sheet, a proportion of it has been recognized as depreciation, right? This depreciation is being adjusted. This depreciation is being adjusted in your cash flow because it has been captured in your net profit. So you're not necessarily making any adjustment to a future depreciation. You are only adjusting an amount that is in your net income that is non-cash. So basically, what you are doing is you are adjusting your net income to reflect the actual cash. You are not necessarily making a provision, because when you say we make a provision, when you're making a provision for debt, or you're making a provision for depreciation for future asset, for example, by the time you're adjusting your cash flow statements, it's not going to reflect the actual cash sitting in your book, because your cash is going to be reduced by the amount of provision you've made in the cash flow statement. But it's not going to be the same amount of cash sitting in your bank or sitting in the cash balance, because you've made a provision for something that has not necessarily occurred, but you've adjusted it in your cash flow statement. So I don't know if that makes sense. So basically, your cash flow is just there to show you the actual amount of cash that is available in the bank or in the cash of the subject company in this case. And what you are only doing is adjusting the non-cash item that you factored into your income statement, in your income statement and your balance sheet, because it does not necessarily involve the movement of cash. So you are just making adjustments so that you can come down to show this is the actual amount of cash after adjusting the non-cash item that we have already recognized in the books. I don't know if that makes sense, but or maybe I'm not understanding the question. Samson?
Again, Damilola, so I think to the best of let's say well, okay, I think Favor mentioned that it's okay. I guess she's fine with your response.
Okay.
Thank you, Favor. Chukwe had mentioned, please, is there any reason for you using different colors, blue and black? Well, I think Tijani has sort of provided a response. Tijani Lawal had mentioned by standard blues hard coded, etc. But yeah, please go ahead.
Okay. Oh, yeah, I mean, so I think when you're modeling, right, you want someone else to look at your model and understand it. And there are industry practices, so that by the time anyone is looking at your model, they have an idea of what happened there. When we start modeling, for example, most historical number are usually in the blue font, just to reflect that anytime you see blue in this model, is either two things. The first thing is that it's an historical number, so it is the actual. And sometimes we also use it for hard-coded number. Let's say when we're making our assumption, or when we're making assumption about the future, we have a particular opinion about what the interest the percentage is going to look like for growth, or what we think the percentage of the particular line item is going to be to sales. So we have all of this hard-coded number in blue. Formulas are most likely in blacks, because by the time you start modeling, you're not just like putting hard-coded number everywhere. You're going to be adding things up, forecasting and whatnot. All of those is going to be in black. There are some extra industry requirements. Most time it sticks it as far as that, those two major font color. But sometimes the industry in some industry practices, they will tell you that we should use red for external links. So let's say you are using the matrix model, income statement is there, balance sheet is there, cash flow statement is there in different tabs, and you want to bring a particular item from the income statement to the balance sheet. They will tell you to, there is an external link from that particular sheet, so you should make it in red. Sometimes also analysts tend to get data from Bloomberg, from all these readers, and they plug it into their model. And most of those times also, when you're bringing in those kind of numbers, it comes in red because it is an external link, because they will link it to the Bloomberg terminal and whatnot. Sometimes also they use green when you are expecting a particular amount from this year to be the same for next year. So let's say you have your finance cost to be 10 in 2022. In 2023, you expect it to be 10 because the debt is still, nothing has changed in terms of you've not repaid your debt, and you've not also raised another debt. So your interest expense is going to be the same. In that kind of situation, you can easily just link your this year interest expenses from the old one, and by the time you are doing equal to the column before. So let's say in column C, you have the interest of 10. In column D, you can just say equal to column C, and they tend to put that in green. So all of these are just different industry practices, so that anyone that is looking at a model can easily know that, oh, these are historical number, these are coded number, these are formulas, these are external, this one is coming from an external sheet or external provider and whatnot. So all of those things is just industry practices.
Thank you, Daniel. I think we can continue. Just noting if there will be a need for that break, but in your estimate, how long do you think we would require more to wrap the session up?
Okay, I've got a few more slides. I mean, let's say, yeah, I've got just two. Yeah, I have just three slides to go.
Okay.
So
okay.
roughly, I would do three. I can do next 15 minutes to round up the three slides,
okay.
Or we can take a break, whichever one works.
No, I think we can wrap up since you're almost done. Let's just really wrap. Thank you. Thank you,
Okay.
Daniela.
Okay, thank you. You're welcome, Samson. So to build or by the time you start modeling, you want to start building your formula, you want to have your assumption sheet, and you want to start making your forecast. The best practice is that you should have your assumption first. So, but let's say, for example, sales is 100 last year, and you're expecting it to grow this year by 10%. So what you're supposed to do is, like you're saying, to say 1 plus 10%, which will give you 1.1, and you multiply it by 100 of last year, it gives you 110, right? So it is best practice to put your assumption first. If you don't do it, it doesn't change anything, but it makes, editing, when you're auditing your formula, or when you're trying to check out where is this particular thing coming from and what, by the time you start doing all of that, you find it easy to navigate around if you have your assumption first before applying it on historical. So your assumption comes first. There are some critical checks by the time you start working on your numbers and everything. So by the time you start preparing your financial statements, you want to do some sanity check here and there. Let's say by the time, the quickest sanity check, is your balance sheet. When we're young, we're always like, when you're preparing your financial accounting 3 statements in school, you want your balance sheet to balance. They will say your balance sheet, does your balance sheet balance or not? So you want your balance sheet to balance, right? And so sanity check is that you want to check if your total asset is equal to your total liability and equity. So that's a sanity check. Another sanity check could be that you want to ensure that the balance in your cash flow statement as your cash and the final figure in your cash flow statement is the same thing with your cash in the balance sheet. So there's a lot of sanity checks. So wherever you can, just ensure that you're doing some sanity check. You are checking that your numbers are correct. Matrix check. I think I've explained it, that your column, the column you are linking, when you have different tabs, you are linking column to column. You are not linking column B to column C. So column to column is what they call matrix check. The stress test is when you want to look at what will happen if you change a particular assumption or a particular input. Let's say growth. So if you expect growth to be 10%, if you are going to be stressing that module up until 1%, what does it mean? How does it change? So basically, those are the kind of critical checks you do when you're building your module. Let me see the next one here. So I have this shortcut. I mean, the shortcut is control and bracket open. It helps you to trace precedent. These are the things that you can you can look at your own convenience. So if you want to edit your formula, also pressing the F2 button or function and F2, if your keyboard has a function, will help you to look at where it helps you to show the formula and give you a breakdown of what's going on. So I think the component of a 3D statement forecast module, these are the things we've talked about over and over. So we start with your historical data. And from your historical data, when you have your historical data in your Excel, then you do an historical ratio. Basically, you are just trying to look at what has happened historically. So gross profit margin, net profit margin, efficiency ratio, liquidity ratio. So those are the different kind of formulas that you can compute from your historical data, can give you an insight into how your forecast is going to look like, or what your assumption is going to look like if it's a stable company. Then, of course, you forecast your assumptions from your historical ratio. Then you forecast the financial statement, which you've mentioned earlier. Then you do a ratio analysis just to look at some relationship that is going on that will be able to help you making a decision by the time you start getting your valuation or when you're doing your financial analysis. So ratio analysis will help you to understand what's going on year on year among the 3 statements. And I think I just did a little smart shape here just to show you what is going on. So from historical data, you go down to historical ratio, then forecast assumption and forecast financial. And then this is the final segment, the final part of my slide, just kind of recap what you're supposed to do by the time you want to build your model. Of course, you start with your income statement. And when you're doing your income statement, most of the time we leave out your interest, and I'll explain that way. By the time we start preparing the model, we tend to use interest statement as part of a revolver, and all of that. We'll explain that. Balance sheet also, you leave out cash and you leave out the revolver, which is also called the overdraft. When you're preparing your cash flow statement, also you use the income statement and relevant schedule to prepare it. Then most of the time there's an argument of, are you going to be driving your cash flow from the balance sheet, or are you going to be driving your balance sheet from the cash flow? When we get to the financial model, we'll get there. Then of course, you balance your balance sheet, but here we prefer the cash flow driving the balance. We prefer the cash flow driving the balance sheet because that makes more logical sense. Then you plug your balance sheet, using your cash flow output, that way. Then from there, integrate your interest model, because we're going to build a debt schedule. Then you would use your interest to complete the model. I think that's pretty much like the presentation. And I think I had some two links that I think you can check out. I think for the first one, it takes you to Asfadamodaran's ratio analysis or financial ratios definition, and the CFA Institute also website has a few materials you could read that will be very helpful. So this completes the part of the presentation. I've stopped sharing let me stop sharing my screen. Or the next bit is the actual work, which is us preparing the financial model. But that is, I don't know, I don't think we can start that today. I don't know what the organizers have in mind. So should we just look at what the model looks like, then we can start doing the whole thing.
So I think it's been a very long morning, and there's another section later this evening. So I think let's please wrap this up today and just allow the students to digest what you have shared. So I think there's a lot. For a lot of students, it's going to be a lot. I think what we would do is to share some, one or two resources alongside the slide with the students.
Okay.
I think we would also just recommend a training on CFI. I think CFI has a free training that they can also leverage. Ahead of next class. We'll communicate that to the society, team, the Safe Society Nigeria office, and see how we can communicate that to the students. So I think if that is done, they are able to, revise what we have done today, take some of those free classes ahead of the session next week, so we can have the second financial model session next week. So I think if they're able to do that between now and next week, it's just going to be, it could be a bit more productive by the time you start the core modeling classes. But again, you can just, show them most of the things you were speaking about, for about 2 hours, just show them what it looks like on the model. And from next week, we can start the modeling properly. Thank you.
Okay, thank you very much, Samson. I know today might be a little bit boring to a lot of people, which is fine. It's a little bit boring to me myself because I've been talking without giving example or practical example, which is not my style. So next week, we are going to be doing the hands-on, model. We are going to prepare financial model. This is what the output looks like. This is the income statement. This is the balance sheet, the cash flow, and the schedule that we're going to prepare. We're going to prepare a bit of schedule, and I think that will caps it. But I think, like Samson said earlier, there's a lot of resources out there that we can use just to get familiar with, how the whole thing plays out. CFI, for example, I think they have a free module, like Samson said. We have the Wall Street prep videos, Paul Pignataro videos, a number of resources out there on financial modeling. But I think the only difference is that a lot of them didn't really take much of their time. They didn't spend more time on explaining how to think about the input and the drivers, which is like the main part of the modeling itself. And I think it's the spirit of the model, having to get to think about how your model work, what should be driving it, how you should think about your input and whatnot. The rest of it is just mechanical. Anyone can get it. But what's going to make a difference as far as this competition is concerned is going to be the reasonability of your input, because that's what is going to flow into your valuation. It's going to flow into your, like, it's what's going to probably be part of what's going to inform your thesis for the company. And by the time you start comparing the company also to the peers, by the time you start comparing the company to their competitors, in your valuation class, they will tell you that it's not about just the company numbers alone. It is when you're thinking of about the stock, you're thinking about this particular company relatively to this particular company. So why should I buy this company and not this other company? And having the right financial analysis, having the right numbers will be able to make you compare this number against the other numbers. It will be able to help you to also help you compare your number to consensus, what the other analysts, or what the other analysts, in this case when I mean other analysts, other university are thinking. So these are the things that's going to make the difference. But I think on the mechanical side of things, which is something we're going to be doing next week, because I'm not going to spend a lot of time trying to explain input drivers and whatnot anymore. We're just going to go directly into it, how it works, how we should link it up together and everything. It's pretty much what's going to happen next week. But I would advise you to probably like take your time to look at CAP, which is your subject company, and just look at their line items, income statement, balance sheet, cash flow. Look at it and ask yourself that, can you make a sense about each of this line item? Can you by the time you probably like read their earnings presentation or their Q3, the most recent report, and probably their annual report, do you think the company has been able to explain how this particular line item is moving? Can you easily think about, the key drivers of this particular line item? Those are the kind of questions I think you should ask yourself before the next class. And if you can also, you can easily play around building a mini module. I think I shared the templates that we're going to be using with Samson. If you could share with you, we can do it together as I'm doing it on the screen. But if you would just like to watch, that's also fine. Yeah, so I think that will end my presentation. If you have any question, I'm very happy for you to ask. And I'm also very open to follow-ups. Thank you very much.
And thank you, Damilola. So what I've done now, and guys, in case everyone can hear me, the proposition will be for you to consider taking some of the free courses I've shared now. There's one on corporate finance, there's one on accounting fundamentals, Excel fundamentals, and learning to read financial statement. Now, all these things would corroborate everything that Lola has been saying. What he has done is essentially to do a high-level summary of all the content of these courses I've shared with you. I think you will find them super useful before the next class next week. As I had mentioned, the objective of this morning class was to sort of introduce your mind into what the expectation should be, or what you need to understand when it comes to financial modeling, the basics, the fundamentals.
I'm not sure if it is me, but I can't hear something.
Not you.
Okay, I think while we wait for Samson, if there's any question that you have on the call and you would like to ask me now, I think now is the time. And if you want to keep your question up until next week, that's also fine. So I think that's pretty much it for me. I think Samson is having some trouble and just dropped out. So probably we'll just wait a little bit for him to come back.
Apologies. I think I've okay. I was logged us for a minute. I don't know where at that point. But yeah, so I was saying that I mean I've shared some links, which of course will be reshared with you. We'll just compile that alongside some other materials that we think you will find super helpful. I think Damola has done a great deal of work to really just walk through a whole lot of content that would be helpful to you. You can corroborate it with some of the lessons you'll find on those links. They are free. You can just register and find some time to take them. But again, as mentioned, the core modeling class will start next week. The intention is to then do the real technical modeling that will involve, the Excel work and projections and how you think about projection, etc. But in the meantime, you can take your time to, as I mentioned, leverage have a bit of AI in supporting your research efforts. You have Google to also support your research efforts. There are a lot of materials out there that can provide a lot of clarity on some things you must have heard on call today that might have sounded alien to you. And you can always also reach out to your faculty. You can reach out to your industry mentors. You can reach out to us, right, for any clarification. I think the important thing is for you to leverage all the resources that you have available to you to strengthen your submission, strengthen your work, and make it just a bit easier. So as mentioned earlier, we would put together some resources that will be shared with you alongside the link that I shared on the chat for everyone to just take advantage of and learn a bit more. But the classes will continue tomorrow on next week. I mean, the financial modeling class will continue next week. I think we have another class for this evening by 4 p.m. and that should be business analysis, I believe. But yeah, I look forward to seeing everyone back here by 4 p.m. We will continue the class at 4 p.m. Please enjoy the rest of your day and see you later. Bye.